Hello and welcome to the CounterSurveil podcast. I am your host, Trez, along here with Nathan Hawk, my
Howdy,
co-host.
everybody.
Today we're going to be talking a little bit about tokenomics, and we're going to have two different guests on. Hopefully they do show up on time, and we're just going to add them right in as soon as they kind of pop in. But to start off, Nathan, what's new with you?
Nothing much. I wanted to bother you with some security questions while I got you because that's all I ever want to do. Can you just give me a little clarity? What would be the difference between pen testing and a more formal assessment?
Sure. So pen testing is generally there's going to be a pretty tight scope on the activities that you can and can't perform. Everything's going to be agreed on beforehand, and the typical report you're going to get is going to be a way that's showing you how the penetration tester was able to get into the environment, what resources they were able to access, and walk you through how to fix those things. An assessment, on the other hand, is a little bit different. Or assessments more have to do with compliance and the GRC world. That stands for governmental, regulatory, and compliance. So typically, like say a SOC 2 assessment is going to be done by a financial auditor, and that person's going to come in, usually an accountant, and they're going to look at a bunch of check boxes. Do they have a firewall? Check. Do they have log forwarding set up? Okay, check. And you kind of get to, especially with like a SOC 2 audit, pick the parts that you want to be tested on, and then you get that nice we're SOC 2 certified kind of thing that you can put on your website. Very similar to a stamp of approval, like, yep, they've been audited, they have the things in place. And a lot of times that's more for like the insurance companies because they want to make sure, for instance, that a company is doing all the things that they should be doing in order to stay protected. Whereas a penetration test is more like how a hacker actually get into your environment and do bad things, and how you can then prevent the most obvious way that they would get in based on the way they got in during the test. And also we have vulnerability assessments, which is a little bit like a pen test, but usually where they don't necessarily check everything. So it's kind of like scanner output, sometimes verified a little bit, but not nearly as comprehensive or with any attempt at exploitation. Oh, and looks like Nathan's here. Sorry, Nate, not Nathan. Don't want to confuse you and our guest here. So I'm going to add Nate to the stage here. Nate, welcome.
Trez, how you doing, man? Nathan, good to see you guys.
Good to see you. It's been a while.
Too.
Been a bit. And we get that confusion all the time. Anytime Nathan and I are up on stage together, it's just Nate, Nathan, Nathaniel. It's back and forth,
Last initial too, man. Total bummer.
It's a rough one. Not to dox myself, but yeah.
Right.
So Nate, why don't you tell us a little bit about Tokenomics? What do you guys do?
Yeah, so I guess we're saying we'll talk a bit about economic security, so I'll lead off with that. As the bio says here, down nice little byline, founder of Tokenomics. So Tokenomics started last year is a protocol design firm, and we focus mostly on economic security and value accrual to tokens. So economic security, I've also in the past was calling it tokenomic security and token economic security. There have just been a lot of different names in the broad space of tokenomics that people have put to the same concepts. And so economic security is one of those things that I think is going to become more popular and more valuable, more widely recognized in the next 5 years because it accounts for such a large, underlies a large percentage of hacks that we're seeing in DeFi today. So economic security, where technical security is a lack of bugs in the code, economic security, you could say, is a lack of bugs in the incentives of a protocol. And so that's what we're mainly focused on defending against and identifying is these economic security exploits and vulnerabilities in DeFi, and that is Tokenomics' main focus and claim to fame.
Very cool. So you had mentioned bugs in the code versus bugs in incentives. For those who might not be initiated into the crypto world, what exactly are incentives, and how do they help drive a crypto project and get more people involved?
Yeah, that's a great place to start. So I guess to back up, I mean, we can start with Bitcoin. I think everybody's familiar with Bitcoin that's listening to this podcast. And the thing to highlight about Bitcoin is, yes, it's an impressive cryptographic, mixture of cryptographic primitives and impressive in some ways in the technical aspects of the protocol. But it's really the economic incentives that have kept Bitcoin afloat all these years and kept it from being subverted to the extent that it hasn't been subverted through economic incentives, right? So it's that the idea that the miners are paid to honestly append transactions to the blockchain. That is the thing, these financial incentives to miners, that's the thing that's really kept Bitcoin alive. And that underlies most of the other blockchain protocols that we see. There are similar incentives in Bitcoin or in Ethereum, though many of the other blockchains use proof of stake. These are still ultimately resting on financial incentives to secure the protocol. And this is actually really timely because right now there's a big debate between the Ethereum and Solana crowds on whether economic security is important or not. You've got Solana saying economic security is a meme, sort of tongue in cheek, but ultimately conceding that Solana is secured by the group of thought leaders at the top who are willing to hard fork the blockchain in the event of a significantly damaging economic attack, where maybe there's a reorg double spend or validators miss some kind of malicious set of transactions or malicious block that inflates the supply. Whatever kind of attack there might be resulting from an economic security and ultimately an economic vulnerability in the protocol, that can be remedied by just injecting enough centralization, enough centralized dependencies into the protocol. So that's kind of something that's going on in the background. Maybe we'll talk about that a little bit. But to loop back to incentives. So it's the financial incentives that keep blockchain protocols secure, and these incentives are also found at the app layer. So different protocols often have incentives for participation that drive users. So, for example, there are relayers in Tornado Cash that are incentivized to participate because they're getting paid to, forward transactions essentially. Or you have liquidators in the MakerDAO protocol for stablecoins that are, they're paid out because they are keeping the protocol from incurring bad debt, which is sort of ultimately an economic security vulnerability itself. So anyway, I could probably go on about incentives, but wanted to give a few examples there for you.
That was a great explanation. So just a few follow-up questions. Say we're talking about incentivizing validators in a proof-of-stake blockchain network. What are some effective ways we could incentivize validators to participate in the validation process? Like, how can the tokenomics design be optimized so that we do achieve that goal?
Yeah, that's a good question. It's a really big question. I think this rests a lot on the different consensus designs, different mechanism designs for blockchain protocols. And there's a lot of academic research out there that hasn't quite been applied in all of these blockchains. What we notice, and it's kind of a common thing that you'll hear in mechanism design and crypto economics spaces, is that there are a lot of untested mechanisms, a lot of research coming from top universities that are proposing different kinds of mechanisms that we rarely see in the wild. Avalanche was one of those that came from an academic background. Emin Gun Sirer is one of the founders of Avalanche, and he's from Cornell. He was doing mechanism design there for, I want to say, maybe a decade. He's had a deep academic background and is one of those people that's brought previously theoretical mechanisms out of the void and into practice. So I guess how to apply this? Well, it's, there's a broad canvas, right? And so that is a matter of bringing existing thoughts into the real world, into fruition. And with that, there's the opportunity to look at it from an economic lens and look at the economic security of these protocols through things like iterative simulations, Monte Carlo simulations. There are a lot of tools in what we have is like the token engineering space is really heavily focused on the mathematics and the the systematic simulation of these protocols through Python packages and things like that, where they're bringing in real like a computer science background and applying that kind of rigor to economic security of these protocols.
Wow, that's pretty interesting. Follow-up question. In a DeFi protocol, how can the tokenomics design be optimized to incentivize liquidity partners to contribute to the protocol? What are some potential strategies for mitigating the risks associated with liquidity provision?
Yeah, that's an interesting one. So there's a lot of different, it kind of depends on the protocol, right? Because DeFi is pretty broad. But there are a few protocols where I think about like the provisioning of liquidity as really essential. And one of those is obviously liquidity pools. So in liquidity pools, the main thing that different liquidity liquidity AMMs really, the AMMs are solving for capital efficiency. And so, they're solving for returns to these liquidity providers where, I guess to backpedal for a second, like give the listeners some context here, an AMM is an automated market maker. And you have, two assets that are traded against each other. And someone can deposit one of the assets for a pro rata share of the other assets in the pool. And in doing that, they're also paying a small premium that goes into the pool to increase the overall value of the pool. And this is governed by a formula called XY equals K. It's the constant product invariant. And this basically allows for users to trade two assets, which are provided by a third party, a liquidity provider, against each other and be able to trade off of exchanges. This was like Uniswap's main innovation. And so since Uniswap, some of the tokenomics considerations, most of the tokenomics considerations and improvements have revolved around increasing the capital efficiency that that users are, that liquidity providers are getting on their assets. So the idea before was in Uniswap, liquidity providers could put in $100 of ETH or 100, 1 ETH and 100 USDC or 1,000 USDC, and they would be earning a few percent on that per year because those assets weren't traded in a very wide range. And so you had protocols like Curve coming around that said, well, let's trade these assets in a more narrow range, and then increase the frequency at which they're traded and the fees that liquidity providers are getting. And so that was one of these, I would say, like loosely tokenomics affiliated optimizations that have been made over time. And so that's actually like a very math heavy kind of thing. And we've at Tokenomics, we've got a bunch of math PhDs on the team. And so anytime like a bonding curve comes up or liquidity optimization, these kinds of things, any kind of optimization problem, I'm deferring to the guys that we have in-house. Octopus, who's a familiar name to the token engineering people listening to this. He's one of the teachers there. He's at Tokenomics, and I pull him in for just about everything that I need with any kind of optimization problem. And so people should check him out. He's OCT8PUS, maybe. I'll have to link him in the clip. But anyway, so this is one of those things that, one of those realms that people might want tokenomics to help optimize, or token economists, token engineers to help optimize. But the challenges that we typically see in these kinds of areas are actually peripheral to the main optimization challenge. So a lot of the time, and there was, I could list a couple of examples of protocols that were AMMs that tried to incentivize liquidity providers in an exogenous way, rather than improving the product itself and competing on that basis. They attempted to provide protection from what, one of the main issues was impermanent loss, and is still impermanent loss in providing liquidity. the Bancor protocol tried to provide impermanent loss protection by giving users tokens proportional to the value that they lost in providing liquidity. So this idea of impermanent loss is like you might nominally gain if you're providing liquidity for ETH and USDC, you might get more of both. But if the price of ETH goes down enough, then you're left with less money. And that happens a lot because when people are trading, they're going to trade the less valuable asset for the more valuable asset in order to arbitrage through a liquidity pool. So Bancor said, well, that's easy. Let's just give them Bancor tokens in order to make up for the losses that they're incurring. And in doing that, they started to precipitate a death spiral where the price of their token was cratering because it was just going to people who were selling it to make up for their losses that they had incurred in the protocol, because fundamentally the protocol was broken in this impermanent loss situation, wherever that, in each case that happened. And so those are the kinds of things that we see people making a lot of mistakes with in tokenomics or in their protocol design. And so that is one of those economic security vulnerabilities. That's one of the many economic security vulnerabilities that we've seen that we have listed in our GitHub, Tokenomics XYZ. We've got a whole repo of the history of economic exploits. And maybe we'll talk a bit about those and how they differ from technical exploits. But that's just one example of like where using the token to try to incentivize some behavior seems like a good idea because the first order consequences make sense, but the second order consequences are not always anticipated, and they're not always easily anticipated. And in these complex financial systems that we're building in DeFi, there are so many interdependencies that second and third order consequences tend to cause a lot of problems. And so that's our area that we focus on, is like, what are the second and third order consequences? How do we find those? Simulation, framework, different tools that we use to identify those. And then there are a variety of mitigations as well.
Wow, I wasn't aware of that happened with Bancor. I'd heard about that, very, very high level, but to hear that's actually the reason that happened is very interesting.
And so this maybe is another good example of like the difference between a technical and an economic exploit, where a technical exploit might have been like Bancor missed a semicolon or had a reentrancy attack. It's not missed a semicolon literally, but that's they might have had a reentrancy attack or something like that, and then people are able to get all of the assets out, right? Like the DAO hack. But in an economic attack, it's a misalignment of incentives somewhere in the protocol, and so those have always been the most interesting to me, because they're these giant arbitrage opportunities that are in DeFi, where like from through the injection of capital, you can gain an unfair advantage in a protocol just because that protocol wasn't designed to handle that kind of change in state. Is really what to boil it down to. And so these are
Wow. How do you guys over at your company, you had mentioned this octopus gentleman you work with, for instance, how does he come up with those kind of solutions? Like, for instance, if he had to measure the potential risks, let me think for a second here.
Yeah, I mean, like I think you have a complete question there. Like, how do we measure the potential risks? So our methodology is in looking at it's kind of a set of heuristics, frameworks. Of course, we're pattern matching on the history of all of the economic exploits, and we've aggregated those in our GitHub for everybody to see. Everyone at Tokenomics has to learn those. So those are those are things that we can apply and just sort of look at protocols and say, is there anything similar here to what we've seen in the past? Like, are there any design choices? And there tend to be many that people make over and over again because they haven't heard about the Bancor exploit, or they haven't heard about the Aave bad debt, all of the times that this lending protocol has has been shit out of luck because someone deposited less value than they withdrew. So there are a lot of design choices that we see repeated, just like reentrancy attacks are still a thing since the DAO hack in Ethereum back in 2016. There are a lot of economic vulnerabilities that tend to crop up again and again. And so we're firstly looking for those kinds of things. That's like a first pass. Beyond that, some of the people, like, we have a really smart and talented team, and they're all thinking very differently. And that's one of the things I love about this collective of people. There's 8 of us now, and everybody thinks a little bit different and applies a little bit different of a lens when they're brought in to analyze a project for economic security vulnerabilities. So we benefit a lot from having this diverse group of people that are thinking differently than each other, and certainly differently than the rest of DeFi, who are not even really tuned into this concept of economic security being a solution to a large swath of problems. But the other thing that we look at is we rely on a couple of metrics, and one of those is the cost to attack. So we're thinking about and looking at and mapping, diagramming out the design of the protocol and the upstream and downstream dependencies of different factors and modules in those protocols to see where is there, a sort of bottleneck or somewhere that we could inject an amount of capital to manipulate the data in that protocol or manipulate the price that is a dependency somewhere in that protocol. For example, today, there was an economic exploit of a lending protocol called UWU, and there was an oracle manipulation. It was a price manipulation attack. So the prices of 5 feeds were the price of 5 feeds on USDE were manipulated to reflect a faulty price, and it ended up with the person manipulating those getting $20 million of the protocol's value. And so this is an example of an upstream dependency. It's like, how do you properly integrate a curve oracle? That question is essential to the economic security of the protocol. So these are the kinds of issues that we see and identify in protocols. We also find novel exploits. There's a lot of things around MEV or around, injecting like flash loaning, large amounts of capital to change the state of the protocol very quickly in a way that you can create bad debt in a lending protocol, and things that I've already mentioned here. There are about 9 distinct categories of economic security vulnerability, and we're looking for all of those, but also like novel exploits, because we're working with novel protocols, novel designs. We're most interested in Tokenomics. Another way that we are, I would say differentiated, but it's like, I would say differentiated, but we don't think of it as a business strategy so much as like an ideological principle that we want to work with things that are censorship resistant. So the protocols that we're working with are often oracle-less. They have no centralized dependencies. They're self-referential, self-contained. And so that leads us to be working on a lot of new things and finding exploits that haven't happened in the wild before, because nothing like the protocol itself has existed before.
You had actually shared with me that you guys have been categorizing some of those and cataloging them on a GitHub repo. I think that's really amazing to have all that centralized someplace, so somebody who wants to learn about it, what kind of attacks have already happened, can go and look at that and see like, hey, this is how that attack happened, and if we got to protect ourselves if we're going to be doing something similar to what those guys did, and make sure we don't make the same mistakes, or even from the hacker perspective, like, oh, I want to be a bad guy and pen test this protocol, but maybe not pen test, and like, how do you necessarily differentiate between like the people who want to use that knowledge for good or evil, or is there any safeguards in place to make sure the bad guys don't figure out the same tricks the good guys are to trying to protect against it?
Yeah, I mean, I think that's one of the biggest questions in DeFi, and I would even boil it down to like, what does it mean to be good or bad as a hacker in DeFi? And I know that's a really controversial question, but we do have this ethos that is a minority, but an early minority of DeFi, of DeFi participants, and that is encapsulated in the phrase "code is law." And so in DeFi, there's a school of thought that says any attack, and it's not even a school of thought, it's like any attack that can happen will happen, because these protocols are immutable, and there's a such thing as flash loans, where large amounts of capital can be borrowed virtually for free, with no credit required, because the loan is repaid within 12 seconds in the next block, and the transaction only executes if it's profitable. So hackers have access to $500 million of capital they can just put toward any kind of protocol. And because economic attacks are mainly using large amounts of capital, injecting large amounts of capital into the protocol to do this, they're mostly concerned with, or they should be more concerned with, the ability of hackers to just flash loan these amounts. And so I would say, to the extent that we do allow other people to pattern match on this GitHub repo, maybe there are more attacks that can be run in DeFi. I personally don't see that as a terrible thing. I think DeFi should be a buyer beware kind of space. And I think I am of the code is law kind of school of thought. And I think that DeFi needs to be in beta testing for a little longer before trying to attract the mainstream. And I really lament the common trend, the common pattern of people to say, like, we need institutions in this space and we need mom and pop in this space. Like, we don't. We absolutely do not. They are not. DeFi is not ready for that. And, people are getting rugged all the time because they're buying into things that they fundamentally don't understand. They haven't examined the code, these kinds of things. On the flip side, there are 100% APY returns to be made in DeFi. Like, people are getting those all the time. But as we know from the history of traditional finance, risk is proportional to reward in a free market, in an efficient market. And DeFi, where all of the information is transparent because this whole thing is open source, is an efficient market. And so that's kind of just, I could probably go on about this and have many, many thoughts on the ethos of code is law. But I'm of the opinion that if something can be broken, it will be broken. And it'd be great if white hats do that for a 10% bounty. There are some solutions I think will be created involving self-regulation and alternatives to regulatory agencies that are going to arise in DeFi. And so, to answer the question of, like, how do we prevent bad guys from getting a hold of this information, we are guarding many of the things that we do, and the kind of people I like to work with are aligned with the broader, the broader goal and the movement of what we're doing. But I think allowing people some minimal amount of access to the history of these exploits and categorizing them in the same way is going to hopefully help white hats more than it helps black hats.
That's great. Nathan, I believe, had a few questions. You there, Nathan?
Yeah, I am. Nate, I wanted to ask you, because you had mentioned the flash loan attacks and you had mentioned re-entry. First off, for those that don't know, could you elaborate a little bit more on those and other types of traditional attacks that you would see that are purely because of economic function of a token?
Yeah, definitely. So flash loan attacks are typically through a lending protocol. Like Aave has a flash loan function, so they're the most popular. And what you can do is construct a transaction on Ethereum and borrow an amount of capital from Aave, an amount of whatever from Aave, and then do whatever you want with it, but only for one block. It's only for the period between the block that you've borrowed from and the block that you're paying it back in. and that's about a 12-second period in Ethereum, roughly 12-second block time. And so you can do anything with, $500 million for 12 seconds, and people will construct really complex transactions to, say, borrow, 50 million from Aave and then turn that 50 million in ETH into like USDC or some other stable coin, and then deposit that into a liquidity pool, trade through that liquidity pool a bunch of times to earn rewards from some small protocol that's paying out rewards proportional to volume, drain the entire protocol of rewards that they're paying out proportional to the volume through liquidity pools, dump the token for a $5 million profit, and then pay back the original, withdraw the 50 million that they had put into liquidity pool, and then pay back the 50 million to Aave, net 5 million, maybe less some fees or something like that. That particular like high level that I just explained, that's happened 3 or 4 times now. Most of them were on Binance Smart Chain, which is a kind of a hilarious ecosystem to watch, because it's full of people that are like smart enough to be developing smart contracts, but not confident enough in what they're developing to put it onto Ethereum. So and you also have like a bunch of degens in the Binance Smart Chain ecosystem who are willing to use contracts like this, and they make really funny mental mistakes in like their protocol design. So some of the best and like funniest exploits, economic exploits, have happened on Binance Smart Chain for like $500,000 because people figure them out pretty quickly, and it's worth, it starts, I guess, being worth exploiters' time once it gets to a 500K TVL or something like that. So that's, that would be like an exploitive way of doing rewards calculations that would involve flash loans. Other times you might have someone flash loaning in order to create bad debt in a lending protocol. Sometimes, a lot of the time, these are coupled with other attack types. So Mango Markets is another really popular and famous, that's a famous exploit. That was kind of the one that I think put economic exploits on the map for everybody, as like a category of exploit that is sort of in some way fundamentally different than a technical exploit. So Abraham Eisenberg was a crypto participant. I don't know, he's a trickster. He's a trickster personality and really controversial guy. And he had been exploiting things through the risk-free raiders, which were a group of people that were going into protocols and basically doing like leveraged buyouts of their governance tokens, and then draining the treasuries and things like that. So he'd had a pretty colored history with economic exploits, but he went to this one protocol, Mango Markets, which allowed people to borrow against the treasury. This is a perpetual futures protocol. So they were allowing people to bet on the price of various assets going up and down relative to each other. And then they would allow people to borrow from the treasury. He manipulated the price of an oracle and then was able to borrow more than borrow the entire treasury to reflect that his unrealized gains on this manipulated asset were like through the roof. So he made off with about $100 million from that exploit, and that's one of those that is like a involves flash loaning to manipulate prices temporarily, so that you can take some kind of action in a protocol that depends on the value of the assets that were flash loan manipulated. And so the higher level here is, or the sort of the heuristic is, protocols are often dependent on things that can be pieces of data that can be manipulated when you have enough money. And because flash loans give anybody the ability to have enough money to do this kind of manipulation, there is a lot of attacks that can be run of this category. And so that's those are the things that we've kept track of in this GitHub repo. We've labeled several of them, like this was a flash loan and here's how they did it, and we have a little bit of a description in each of those with the amounts that were lost, the amounts that the hacker netted, and then a couple other factors there. But there are many different types, and flash loans are one of those components that are used in most of them.
So if I'm understanding this right, it's like he almost took out a loan, a very quick loan at a very low interest rate, and then used that borrowed cryptocurrency and manipulate the price of the Mango token, and then pay back the loan and walk away with 100 million.
Yeah, he got so he manipulated the price of one of the assets in the that was allowed to trade on the Mango Markets protocol, and the token ended up going to zero because it was represented share of the treasury. But he manipulated one of the oracles by changing the price of the asset that was used to show a larger than like an artificially large profit and loss, unrealized gain. And I see Nathan is showing us Mango hard seltzer. Yeah, so Mango Markets, really interesting one to look at. But what's crazy is the same exploit was run on Moolah Markets, which was basically the same kind of thing. A couple weeks, a couple months later. And so these kinds of exploits show up all the time, and they're repeated. And that's why it's been valuable for us to pattern match on this history and just get everybody upskilled and understanding what exploits have happened, because they tend to happen more than once. Even though people, you'd think that they'd be like, oh, our protocol works like that, we should fix that. They don't. And that's maybe a whole different story. But the same kinds of economic exploits continue to happen and are popular for a couple years before people really start to figure things out.
All right. Follow-up question would be, what would be an example of just an original sin in protocol development? What type of reckless structuring are you seeing over and over and over again that ought not be repeated?
Oh man, this is such a great question. This is one of my favorite things. So I haven't seen anyone else really talk about this, but the idea that that the market cap of an asset, or the value of a number of assets, is the quantity of those assets times the last traded price, is retarded. This is called mark-to-market accounting, and it's borrowed from traditional finance, and it underlies most of the exploits, most of the economic exploits that we see in crypto. And so the problem is, like, that assumes that the demand curve for an asset is flat. So you have supply and demand. The people that are familiar with that will understand that if you move the curve one way, then the price changes in a certain way, because the intersections of the curve are going to dictate the price. The problem with mark-to-market accounting is, like, yeah, maybe you could sell one ETH for $3,700 right now, but you could probably sell 100 ETH for $3,700 without even, 3,700 each, without even changing the price. But you can't sell 1,000 ETH without changing the price a little bit, and you can't sell a million ETH without changing the price a lot. And so the exploits that have happened in many protocols that are economic in nature have been because of this mark-to-market accounting fallacy. And so if there's one thing that I would say I hope to see change in the thinking around protocols and protocol design, it would be in not marking to market the assets that are being used in these protocols on the protocol's balance sheets. And there's a lot of ways I could go into that. Like Terra is an example of a vulnerability that was due to mark-to-market accounting. People assumed there was an infinite demand for Anchor, an infinite demand for Luna. Luna was collateralizing the Anchor UST stablecoin, and people lost confidence in Luna. The price dropped very quickly, and UST holders were SOL. That is because of mark-to-market accounting and the assumptions that come with that. And so, at an even higher level than the mark-to-market accounting example, porting over, things from TradFi does not work and should not work in DeFi. We're building an entirely new financial system, and people have to reason from first principles rather than by analogy. And I think that is I think it's possible for people to do that because we have a lot of brilliant minds in this space, and people are thinking fresh. They're not a lot of kids that are developing have never worked a traditional corporate job, let alone been on Wall Street. And I think that's a great asset. And so what I hope to see is that people begin to design protocols from first principles and thinking from, starting from the ground up, building from the ground up, not just doing things the way that TradFi has done them, but really thinking critically about like how we want a new financial system to be designed.
Wow. So a kind of conclusion of that is like mark-to-market accounting is financial reporting technique that values assets at their current value rather than the historical cost. And that's what caused all these issues, at least from what I'm understanding. And if I'm misunderstanding, please definitely correct me.
Well, no, that is, I guess, the correct definition of mark-to-market accounting. I extend it to further apply to like I would say even further than that, the historical cost may not reflect the current cost. And so what crypto protocols are doing is assuming that the current value of all of the assets is the current value of one of the assets that was just traded. So ETH trades for 3,700. They say we have 10 ETH, we have $37,000. Could be, but what if there isn't 10 ETH worth of demand in the market? That is the kind of thing that breaks protocols, is these assumptions that people are making around the financial incentives and the financial accounting of these protocols that ends up coming back to bite them. And so to kind of bring this full circle to what we do, it's like we have this financial lens that we're viewing things through, this lens of economics and tokenomics, and this whole discipline that we're applying to the protocol design that we're not really seeing a lot of in crypto. And I can kind of go into like where Tokenomics fits into all of the audit space and like security space broadly, and maybe transition it to other security topics, because I know Nathan and yourself are experts in traditional cybersecurity, and that I think that includes economic security, but we're probably a very small part even of the future of the cybersecurity industry.
Yeah, I do want to drive home the point that I am definitely not an expert by any means in cybersecurity. I just know quite a bit about the industry and know a lot of hackers. Enough to help out the blockchain space, which is what I've been trying to do for years. And for some reason, there's just an extraordinary amount of resistance. I've got a question for you. Have there been any reorgs or rollbacks or anything like that you could cite because of an economic vulnerability that was discovered, like in a white hat kind of scenario, on a token after it was launched?
Yeah, I don't know about white hat reorgs and rollbacks. I think the white hats have tended to report things to the teams, but I'm not remembering any exploits that have happened in the wild. Reorgs and rollbacks, there was one on BSV. There might have been 2 or 3 on BSV in the last few years. I suspect exchanges were hurt by those, but didn't report because they didn't want to cause a panic. Because I don't think there's a lot of great reasons to reorg the Bitcoin SV chain unless you're double spending a counterparty. And there, who knows what's going on in the background there, right? But I do know there were like a couple of 100 block reorgs in Bitcoin SV. There are some theoretical attacks, like reorgs of proof of work chains that haven't been run yet, but not too many reorgs like that there have been some things on like Ethereum recently had a couple of people demo a proof of concept where they prevented anyone else from using a block for just half an ETH. That was like $1,000 at the time. And that was a big deal because it showed that you could prevent someone from using the Ethereum chain, if only for a short period of time. I'd imagine that exploit could be used in the wild to prevent some kind of protocol from properly transitioning its parameters. If it says like we're updating at block 2 million, then that block comes and nobody can use that block. Well, what happens to the protocol in that case? I guess they've just used a greater than sign, but that's the one that comes to mind because there haven't been too many rollbacks or reorgs of chains, because this is that's like the highest stakes kind of economic exploit that you could expect to find. Like most of those that I've given as examples are in the app layer. They're on top of blockchains. They're not of the blockchains themselves. And if those things happen, like you have reorgs are devastating events for blockchain's credibility, and we haven't seen too many of them in the wild, unless you're thinking of one that I'm not remembering. I mean, there's obviously Ethereum had their reorg from the DAO hack, but that was not so much economic as a technical. That was a technical exploit, and then it was a social consensus hard fork.
Yeah. I don't have anything to add to that because it's a little beyond my knowledge level there within crypto, but I bet Viz does.
Yeah. Can you guys hear me?
Yeah, sound good, man.
Yeah. So reorgs are a little bit different. That's a natural part of Nakamoto consensus. I don't believe Ethereum has the capability of doing that just because they have states. That's why they have uncle blocks. So they don't really have that, because I mean, I've written smart contract engine. It's a pain in the butt to roll back your state because you can't reverse computation, because if you're doing exponentiation, now you got logarithms, right? And they have a state tree, so they use that with their uncle blocks. But what happened with the DAO hack is they actually forcibly changed and broke the protocol and made an exception for the cryptography on that one contract. So when the DAO hack happened, it was a recursive call exploit. So what essentially happened is a hacker figured out that he could withdraw funds to a child DAO through this recursion, which is essentially calling the same function with itself. But then the Ethereum state tree didn't update balances every time the recursive call was executed. And so therefore he was able to drain a large amount of the ETH into a child DAO, which had a 1 month maturation period. And then that's when they had this philosophical issue of like, okay, well, is code law? Well, what happens if there's a bug in the code and the code is law? Is it still law? And ultimately what they ended up doing was basically breaking the cryptography on that specific contract, because as it's a blockchain, right, the hash previous has to, be included, in the next block. And so if you change any amount of data in that block, which they did, then it breaks the entire chain. So you have to put a little, basically an exception in there to say, okay, well, for this block, that hash doesn't have to match. And they with basically a withdrawal contract. And that's essentially what happened there. And that's where the big philosophical issue with Ethereum came out. And the Ethereum Classic guys just continued to mine Ethereum with that DAO hack completed. And I don't think I ever saw the coins move on Ethereum Classic, but it created a huge philosophical divide in blockchain where it's like, okay, well, you guys are talking about code as law. This is supposed to be this decentralized system that can't be censored, and you censored it and showed developmental censorship and developmental centralization is being really a fundamental flaw in blockchains. As decentralized as they are, we've seen the same thing with the block size debate and segregated witness for Bitcoin, for instance. So yeah, it created a big philosophical issue. So reorganizations themselves are kind of a natural part of the consensus. It doesn't necessarily mean that there's going to be a double spend. The only way you can really do a double spend is with a Finny attack. But the Bitcoin core developers did open that up with replace by fee and making it easier to execute such a thing. But a Finny attack basically is where you submit a transaction and you get it included on a block at zero confirmation and have a merchant accept that, and then you mine a block with a conflicting input. Then that's how you execute a double spend. But just a reorg by itself does not mean that money was stolen. It's just a natural way. If you have two blocks that have the same height, whatever one ends up having most cumulative proof of work is the one that ends up winning. And that's essentially Bitcoin is managed. And that's the big kind of philosophical issue that Roger Ver, I think, ran into with Bitcoin Cash, which I appreciate what he was doing. But I think a big thing that he missed is that Bitcoin is not whatever we say it is. It's protocol-wise, it's the chain with the most proof of work cumulatively from the Genesis block, and that still is Bitcoin, unfortunately. But yeah, that's a little bit of history on all that stuff. But yeah, hope that adds
I
some
agree.
context.
Wow.
I agree with
That
all
was
your sentiments, and I should have caveated the reorg double spend rather than just reorg outright.
Yeah. Both Viz and Nate, question for you. It seems there's such a steep learning curve for somebody coming from a traditional information security background into the blockchain space. If somebody's new at this, where would you recommend they get started?
Yeah, I think it depends on which chain you're looking at providing security for. I mean, there are a few different main programming languages that are used and different architectures for blockchains. I'd say specializing in one is probably the way to go. It's going to be a lot easier to start on a chain that you're familiar with the language of, where there's smart contracting and Rust on Solana, or Solidity, which is kind of like JavaScript, Python sort of. Colin will probably have some other ideas on this, but I would say Speedrun Ethereum is the go-to website for learning how to write smart contracts on Ethereum, and a lot of the kind of security that you might provide in Ethereum would be around smart contracts. But also I think Trez, we've spoken about this a little bit, that there's an extreme lack of technical expertise and best practices in the crypto space with just basic cybersecurity best practices. People are leaving their secret keys in their GitHub repo and on deployment, and then those are getting automatically swept by bots that are looking for this kind of thing because it's so common. Basic mistakes that people are making. So there's a lot of room for traditional cybersecurity auditors or participants to come in and add value to the crypto space. But I'm sure, I think you guys will probably have some more to say on that.
Well, do you guys have more to say on that? Silence. Well, I guess they don't. But Speedrun Ethereum looks like a great freaking starting point. So thank you for that resource. I popped it up there. Some other questions for you while we still have you. As somebody who's really knowledgeable in this space, who has worked with many different companies and helped them better their overall security, what would you say the most beneficial advice you could give to somebody who's running a blockchain-based organization could be in terms of ensuring that their product is secure?
And is that one for me or for some of the other guys? Because I could answer that.
That's
but
very much for you, Nate.
Yeah. So we're like very focused on the economic security of the protocols, and so that's going to be more about the protocol design and things. And I don't think I'm probably not the best person for like the broader security tips. But with economic security, like the number one thing that you can do is work from first principles rather than from reasoning by analogy or porting over code from what other people have done. It's way harder, but it's going to give you a better insight into how your system works and what the interdependencies are. So from a very basic perspective, like building as much as you can based on your own thinking and insights, rather than saying like, oh, VE tokenomics worked for this protocol over here, we're going to do that too. Not realizing that like this particular module of what is code, but like also what is like design primitive might not fit with the rest of the mechanisms that you're including in your protocol design. So that would be like the high level advice that I could give, is like think from first principles, build from like the ground up. And that doesn't mean don't import like standard contracts that pieces of code that people have refined before, and like don't use it's not saying don't use ERC, IP, like previous specs that have been created by other people. It's just to say, when you're designing the protocol in this design phase, be thinking about things like holistically and from first principles, building from the ground up.
I think that's great advice, and I think a lot of that could definitely go for a lot of non-traditional projects as well, like not just in the crypto space, but building from first principles. Very solid advice overall. So thank you so much. Is there anything else that you would like to add, or any other conversational topics you think we should explore while you're on?
Conversational topics. I mean, I'm interested to hear some of Vidalit's expertise and Nathan's expertise on some of the tangential security topics to economic security. I mean, I guess maybe to frame this a little bit and to close things out, to go full circle, we started by talking about what token dynamics is, and maybe I'll finish after having given people examples of what economic exploits look like and how they're different from technical exploits. The way that I see it, we have a 4-stage protocol design process. So when we're building a protocol, the first thing we're doing is gathering business requirements and getting a product spec, right? We're saying, what does this thing need to do? The second step, and that is typically that's validated by VCs. They're going to say, is this a valuable protocol? Is this something we want to invest in? Does this, should this thing move forward? And if people have a good protocol design, then it gets funded. Then we have the product, the protocol design itself, the mechanisms that are included, and then you're translating the product spec into the design of the protocol. That is like the building out a protocol and what the system should do and how this thing should work, what kind of game theoretical mechanisms need to be included. That's then ported over to the code, and it's in the transition between the design and the code, or the code architecture, or like the code itself. Those are steps 3 and 4, just to close that thought there. But when you're porting over the design to the code, those are when technical issues tend to arise. But it's when you're porting over the product spec to the system design, to the protocol design, that economic vulnerabilities tend to arise. And so that is you can see that economic security is sort of precedes technical security and is just a part of the protocol design process, where the realm of auditors, of technical code auditors in crypto, is more focused on whether the code does what it's supposed to do. Our role is to say, should the code be doing that thing in the first place, and is that a smart way to design a protocol? And no one really does that, because VCs don't have the technical background or really the critical thinking to decide whether a protocol is designed well or not. They're many times not interested. They want a quick 10x, and other times they're just not sophisticated enough, to be frank, to identify these kinds of issues in protocol design. And so that's where our role really is. But there are a lot more considerations to protocol design, or building a protocol, and namely, in the technical implementation of that protocol. Like Vidalit just gave the example of the DAO hack, technical exploit, huge exploit, and there are many of those. They happen every day in crypto. So I definitely want to call attention to that and not overstate our scope. So I would say, that's where I see our narrow role in crypto being very important. A significant percentage of TVL comes from economic exploits, or hacked TVL comes from economic exploits, but it's by no means the whole thing.
Very good. Biz, Nathan, what do you guys have to add?
I got a quick question, and this is for both Nate and Viz. Is there a certain theater blockchain where you see this happening more?
Yeah, I think
Question a little bit more.
Yeah, the blockchains with the largest TVL.
Yeah.
So we see this happening more with TVL, right? And I guess that's like maybe an obvious statement, but there tends to be people just have not specialized. I guess people ask me like, why doesn't this happen? And they don't. Only a couple people have asked, but there is this trope that like exploits don't happen on non-EVM chains. That's because nobody's using non-EVM chains, and the smart people are using non-EVM chains. I think this is
Viz, I'm really sorry, but you're cutting out pretty hardcore. I don't think I can hear you. It might be me. Could be me. Hello?
Sorry, is Viz still there? I was speaking, but
Yeah,
maybe
I'm here.
it's
Nate
me
was
that you guys are
talking.
talking about.
Yeah.
Yeah. Am I back? All right.
I can hear you, Nate.
Okay, cool. Okay, well, yeah, I mean, I can kind of continue that thought. Like, I'll just keep going with that. But basically, Cardano has just started to get some of these economic exploits. Oracle manipulations are starting to happen in Cardano. They have a big issue in some of their lending markets, and they're taking the steps that they need to mitigate them. But I think that for a long time, Cardano was like throwing stones at Ethereum, saying like 0 days since the last EVM exploit and things like that. And it's like, well, that's because people are interested in hackers are interested in making money on these exploits, and there's no money to be made in the Cardano ecosystem. And furthermore, it's like the lion's share of intelligence is focused in the Ethereum ecosystem. From what I've seen, and I'm not an ETH maxi by any means, but I call things as I see them, and I think that is the case based on all of the people from various chains that I've interacted with. It's just like the people that are most serious about game theory, mechanism design, and the kinds of things that you need to be familiar with to identify these kinds of exploits are living in the Ethereum ecosystem.
Yeah, I'd agree. Just from having my experience in blockchain, you usually don't get exploits until it becomes economically profitable or there's some sort of philosophical issue, right? Like the DAO hack, for instance, like it doesn't look like that hacker made out money on that. They did it to prove a point to show developer centralization. But I have seen that, the Ethereum virtual machine documentation, everything, it's littered with red flags. And this kind of gets to my point that I think I'm a bit of a critic of the space of everybody will just create something and then claim it's this bulletproof thing, and I think securities best practices have been severely neglected, especially that this is an unknown industry as far as like the way the technology is going to manifest in the world at large, and the attack surface of it's not known. And I think lack of respect for the knowing that you don't know, I think, is something that's caused so many of these things to happen. And I mean, bad wallet publishers like Nathan, if you remember, what Adrian figured out with 64-bit private keys from an Ethereum wallet that was created. And it's really hard to enforce best practices. You have a lot of people that, see all this money coming into the industry, and then they just jump in with lack of respect for the regard that this is a completely new technology. It requires a completely new way of thought, and that includes also in your security measures. And that's something that I've at least learned from being in the space for about, 10 or 11 years now, is that you're not going to know everything. You're not going to see it, and you have to change the entire way you think. And I'm seeing all these corporate VCs and whatever else, people funding all these different projects and want to make their coins and then claiming that it's going to change everything, just like Ethereum did with the DAO. And they don't respect fully the extent of what security measures are important. And I think the most important one, like you said, starting from the ground up, that's really important, being methodical and not putting too much liquidity into the protocol until you understand the attack surface well enough. And unfortunately, time is really the only thing that gives you that certainty, and just how cryptography is developed too. If you don't have enough crypto analysis, or you roll your own crypto, you don't know what you don't know, and you make a simple mistake, like, an extra plus sign or an extra minus sign, and then all of a sudden, everything blows up and somebody exploits it. And so I think those best practices are neglected in crypto, which has kind of been giving it a little bit of a bad name, saying how many coins are constantly being stolen. And also just architectural issues too, is it's, be your own bank, but if I have to manage this private key on my disk, I've heard people that uninstall Bitcoin wallets and they've lost all their Bitcoin, and it's $50,000 sometimes. And so there's also other architectural issues that I think lean towards creating more of these possible security flaws. Like I said earlier in the Ethereum documentation, you read through it, every like 20, 30 lines, there's a big red, like, hey, don't do this because this can happen. And then people just don't know what they don't know. And I don't think there's been enough forethought before these protocols were developed to really assure that like it's going to have at least a reasonable security. And like, Nathan may have talked there, it's not really well known yet either. You can't really put a stamp of approval on a smart contract because we don't have the entire time to understand the attack surface and to be able to. So any really security audit is kind of like a rubber stamp at this point because we don't know until we know. And sometimes knowing costs people millions of dollars.
Yeah, and that's what Nate is taking care of over with Tokenomics, and it's a really noble pursuit, and it's something that's pretty novel, and people aren't paying enough attention to, like you had mentioned, Viz. Now, Nate, you did mention that you were going to have to leave us at one point, and so I didn't know if you're going to have to jump up and leave mid-conversation. I want to make sure that you get to plug all of your stuff, let people know where they can find you on social media, things of that nature. What do you got for us?
Yeah, I appreciate that, Nathan. Thanks. And I'd love to stay longer, but I appreciate getting to chat with you guys. Yeah, for viewers, they can find us Tokenomics on Twitter, just all one word. And that's the best way to keep up with what we're doing, the kind of things that we're thinking about, talking about, keep up with, the little sound bites and clips that we're posting on Twitter is going to be the best place to find us. Our website is tokenomics.xyz for those people that are interested in reaching out to us. And yeah, we'd love to chat with anyone. We're looking to bring on more people as team members and train people on this kind of stuff. Particularly interested in people who value censorship resistance and think that crypto is a tool for economic and social freedom. That's our target audience of people that we want to be working with and building protocols for. So if that describes you, please reach out to me. My personal Twitter is official ESC, as in Eat Sleep Crypto. And but yeah, Nathan, thanks for the call out, and I'm looking forward to chatting with you guys further and seeing the recap of this later.
Thanks a lot, man. It was great catching up with you.
Likewise. Catch you guys later.
Yeah, Nate, thanks for following a really methodical approach and a responsible security approach in crypto. It's a breath of fresh air.
Likewise.
Yeah, we're going to keep it up every goddamn week until bring them kicking and screaming if we have to.
For sure. Yeah, I appreciate it. We'll have to chat more about that later too, Viz. Thanks, guys. Catch you.
Absolutely, brother.
Now, Colin, how you doing, man?
I'm doing. We're gonna jump into criticizing the technical aspects, or what are we doing from here?
Yeah, I think that's exactly the path that we want to take. Is we're going to try to do this episode to really dig into tokenomics and get it out of the way. I think that the benefit of doing this is any InfoSec people that do have an interest in crypto, that they can see these added attack surfaces and know that there are people that are taking those considerations in stride. The one thing that I think is very unfair, to developers and to InfoSec pros alike, is that we have this added attack surface, and that they ought not, if they want to build a blockchain vertical, have to worry about covering this stuff, and that there would be people that specialize in it, much like they would specialize in assessments or pen testing.
Yeah, it's really interesting. Yeah, you can go Trez.
Oh, I just wanted to give you a warm welcome. I know we kind of have brought you in a little bit early so you could talk with our previous guest, but for those who are watching and might not know who you are, I just wanted to give you an opportunity to introduce yourself, talk a little bit about Nexus, and also I wanted to thank you and the Nexus team for all your support and helping us when we were putting on our Security Mindset Reset event. Really do appreciate all of you, and just wanted to mention that before letting you hop on officially there.
Yeah, absolutely. It's good. We really like to support the security industry, and I mean Nathan and myself have been talking about this, or bitching about it, if you want to say that, about just the practices in crypto and how it's created this whole new swarm of issues that I think are not really being taken responsibly, and it's so easy to just make ridiculous amounts of money and it's usually the people that are investing in those projects that end up paying for it rather than developers. So, we definitely like to help support the security industry and, bring best practices and, rally kind of some more security people around it too, because there's a lot of security people that don't really get too into blockchain because, a lot of it is quite silly. Meme coins are like a big thing. And I really personally believe the cart's been put before the horse just because there's so much money to be made in the hype and the dream of something rather than the actual application of it. And thus we are here.
Absolutely.
So.
And to further that, I mean, even within the hacker community, I've seen a lot of negative talk just about crypto projects in general. At DEF CON, I mean, they don't even have the blockchain village anymore due to, I think, a lot in part of the negative stereotypes that have persisted due to those bad apples who have, taken advantage of the market and done things like projects where they're really not demonstrating the best use case for the technology and instead just trying to make a quick buck. But at the same time, it's such an amazing ecosystem, and there's so much to learn and so much real benefit that can come from having these distributed databases called blockchains where records can be written and updated and be immutable. And there's so many use cases for average businesses, and well, not everything necessarily needs to be on Web3 and be a blockchain-based project. I do think there's a very large untapped market for things that could be Web2 projects that get elevated to become Web3 projects and add some of their infrastructure and backbone to a blockchain to function more efficiently, and a whole host of other advantages to it. Can you talk to that at all?
Yeah, I mean, I'll speak in favor of that and also in criticism of it because there is, that's the dream and that's what I'm talking about. There is, but if you look, there's really not a whole lot of blockchain applications. It's all just, the tokenomics and the meme coins and launching new ICOs, right? If you really look, there's not a whole lot of apps that are like, hey, this is actually effectively powered with blockchain. And I think a lot of that is just like this overhype. I mean, everybody saw the potential of it, and Ethereum was really, I think, partially responsible for that. When they launched, they were talking about having running countries on it, and it's going to change everything. But then the limitations of the technology itself have become, more and more apparent as time has gone on, and that's where I consider blockchain kind of like the vacuum tube. Right? If anybody remembers the vacuum tube, it's it's why computers used to be the size of a room. It's the proof of concept. It shows that we can have a high speed switch, and then it shows that we can start performing logic gates and doing basic computation. But it was too expensive to really fit in everybody's pocket. It was the transistor that ended up winning because it became cheap enough to manufacture and we could shrink it up into a small enough space that it could provide that adequate computing power for, phones eventually to be put in our pockets. So that's kind of how I see the blockchain. Is the promise of it, the vacuum tube, it's there. We can perform basic logic gates and it functions to some degree, but it's the transistor that I think is going to win the game. And a lot of people even talk it up. Like you see Avalanche, they, directed acyclic graphs and they go through there, but then they start realizing there's other limitations. And then you have the Byzantine generals problem. And it's a really interesting space to be a part of. And I really appreciate the technology as it stands now, but I also recognize that you're not going to get to that level of global scale with the current architectures as they exist. And so other people end up cutting corners. Like you have Solana, where it's basically a centralized authentication system. You have Ripple, and the faster ones are really become centralized. And then that comes into another problem with like development centralization, and that ultimately becomes the biggest security flaw. As in classical, InfoSec, the people are the biggest security flaw, right, Frank?
Absolutely.
It's
the human element of security.
Exactly. So now you have people that are coding it, and only a small number of people, like let's call it Blockstream, for instance, on Bitcoin. And, all you have to do is corrupt a few of them and they control all of the code that's pushed out. And thus now we have $100 transaction fees on Bitcoin because of this block size debate, which people are now starting to be like, oh, well, the block size can be increased safely now because of whatever reasons. But you look back in time when this was happening, I mean, $150, $200 transactions, if you remember, and I think it was 2017, 2018, might have been a little earlier. And I mean, the whole narrative of the no big blocks was that, mom and pop can't run a node because it's going to take too much disk space. But, the cost of a hard drive, with terabyte back then was about $100, and now your transaction fees would cover the cost of that. And so that's just a good example of like the development centralization and how that spun this narrative that ultimately limited Bitcoin, and now has cost everybody using it now just because of the decisions of a few people. And I think that's the biggest flaw in it right now, is that developmental centralization, and people generally, when they don't understand it, they'll just, you know, update the security. And then also, like I said, people rushing to market. Ethereum totally rushed to market because they ran out of money, right? They raised $15 million, and then the price of Bitcoin cut in half, and they moved to the most expensive place in the world, Zug, Switzerland. And they ran out of money towards the end, so they had to cut a lot of corners just to get it to market, so they could have their ETH that, you know, was minted on top of the ICO for their foundation in order to keep, you know, living their lifestyles. And now they've locked themselves in. As you probably know with software, like once you build the foundation of it, it's very, very difficult to change it. And you know, just a simple example of like, well, hey, we're going to fix it with sharding, right? You know, and now they've dropped sharding and go L2s, right? And I think they have like plasma first, and then like, oh, now these sharding, and it's just all these hypothetical ideas that then reflect the speculation in the market, which then makes everybody, you know, it's going to change. But then all these people get invested in it, and then they protect their investment because they don't want to lose, you know, how much they put into it. And so then they'll even protect bad ideas and bad
So is that like a
security
sunk cost fallacy almost?
I guess so. Yeah, it's a big problem. There's so many game theory issues in it, and then just, you know, the roots of crypto, what it was originally intended to do. It's, you know, now it's digital gold instead of digital cash. You know, and I'm not speaking for or against Bitcoin Cash in that sense, but you know, if you look at Satoshi's original intentions of it, you know, there was markets. Actually, I host Bitcoin 1.0, like the very first Bitcoin ever released, with Satoshi's published letter on our GitHub. Just, you know, for anybody that's browsing around that wants to go look in it, because you can see exactly all the intentions of Satoshi in that original code. And some of it was taken out, including the markets, right? He wanted to create peer-to-peer markets built into the Bitcoin protocol. He wanted to create a truly democratized, decentralized system. And Satoshi was a benevolent person, so therefore he could steward the project Bitcoin forward, eventually handed over Gavin Andresen. But, you know, now looking at it, you know, back, big corporation, Blockstream takes it over. They limit the actual script opcodes because they don't want all these things. And they have created, you know, censorship. You know, miners do not have to process a transaction. So if you create a control of the 5 mining pools, you can censor transactions. They'll never get confirmed. They'll just stay indefinitely in the memory pool, right? So that, you know, the concept and the idea and the promise of it, yes, it's partially there, just like the vacuum cube, you know, vacuum tube was partially there. But like in practice, there's all these different flaws that, you know, I guess can counter that promise. And that's where I say that there's architectural issues that need to be assessed and looked at in order for, I think, it to truly realize the vision that was set out by Satoshi.
Yeah, I mean, I think there's been quite a corruption of the original vision of what Satoshi had in mind. A lot of people just see it as a cash. Whoa, what was that?
Yes, sorry about that. Yeah, I should have been muted. Someone was being chased by a scorpion in a video game. It was tragic.
Oh, no. So as I was saying before the scorpion incident there, you know, Satoshi's vision for what Bitcoin was going to be, when you read that original white paper, is very, very different than what it's become. And I wonder, you know, if he is still out there, what he would really think about what's happened to what he built, and if he were going to build it again from the ground up, what he would do differently to prevent that from happening again.
Yeah, and that's kind of how I see it too, right? Like, I mean, I think you can tell with UTXO, for instance, it's a very, very clunky architecture. That's why it's kind of funny when Cardano says, "Oh, UTXO for, you know, smart contracts," and it's some feature. Like, UTXO is really just designed to create partial anonymity, right? Where you couldn't find the inputs match the outputs. If you have enough inputs and outputs, then, you know, the collective input sum versus the collective output sum, you don't know what one's linked to what, right? So it created some sort of pseudo anonymity, and that was the intent anyway. But it's been broken. Right? UTXO is even with mixers, it's still traceable. They have AIs doing it now. I mean, look at Mimblewimble, which Mimblewimble is like taking that one step further, saying, okay, well, we're going to just take every single input and every single output and put it into one big block transaction. And, you know, therefore, you know, the more people using it, then the harder it is going to be to trace what funds are going where. But one guy, I think, with just a single server, you know, created a supernode, connected to every single connection, and then he could see all the transactions where they originated from, and boom, the Mimblewimble was broken, right? So I think Satoshi really was aiming at creating this kind of digital cash that had pseudo-anonymity because cash is, anonymous, right? But the UTXO requires a signature per input. So, the signature verification is the highest, it requires the most computational resources. And number two, it takes the most space in the blockchain, right? So that in itself, architecturally didn't, I think, fully meet it. And, I think if Satoshi were looking back, I mean, I like to think that we're continuing his work, but that's just a subjective. I mean, the way that, I've come to that is, like I said, by reading the very first Bitcoin source code and then starting with, some old Bitcoin code and just understanding and reading comments, right? Like as a coder, there's a certain psychological fingerprint, I guess you could say, in the way somebody codes something, and the way they think is, if you're able to kind of grok that, for lack of better words, you're going to be able to see what they were thinking and what they wanted to do with it, right? For instance, like Satoshi didn't want to have the median time passed. Right now, like Bitcoin blocks have, I think, a 2-hour median. It can be like before or after a certain block. So the times of the blocks can, not necessarily be sequential. And part of that is because, you have clock drift, micro voltage oscillations in the processors, cause slight variations in the ticks that each processor sees. And so over a long period of time, clocks are going to drift away from each other, computer clocks, because the ticks are regulated by, the piezoelectric effect, applying voltage to the quartz crystal, and then it vibrates based on the voltage a certain number of ticks per second, and that's what gives you your clock. So clocks naturally drift off from each other. So if you need to have this consensus network, the times have to be synchronized. And in one of Satoshi's comments, he talked about NTP, Network Time Protocol. And I was like, oh, that's interesting. Like network time protocol. Oh, but that's a centralized server, timekeeping system. That's actually why the Ethereum testnet forked, if you guys remember that, because their NTP service went down, right? Which Ethereum, I think, is still relying on a centralized NTP service because they have to have clock synchronization for their proof of stake. But, I saw that and I was like, okay, let's build a decentralized timekeeping protocol. So that was like actually one of the first things that I built for Nexus.
That's about time.
Yeah, and these things need to happen, right? And the Bitcoin wasn't done, but everybody just took it, and that's even Ethereum. It's still it's still Bitcoin. Like Bitcoin had smart contracts. They just added an extra abstracted language that compiles into the bytecode and a few more opcodes, including jump, which Satoshi deliberately did not include. If you read some of the original comments, it says this script is a stack machine like Forth. It is not Turing complete. And so you can imagine Vitalik goes in there and goes, oh, it's not Turing complete. What if we make one that's Turing complete? And then now you have Ethereum, right? And all the other problems that came from it. And so it's just this reactive responses to it. And I don't think most of the projects that I've seen anyway are within that vision, including centralized exchanges. I mean, we saw all the Binance madness where, CZ was telling everybody to keep your coins on Binance because it's safer. And in some senses, he's correct that if they protect and provide the security, then like it's going to be safer than you managing your own coins. But that's totally the antithesis of crypto, which is not your keys, not your crypto, not your coins. And then places like Binance then go and they spend everybody's funds. That's if you read the SEC allegations against CZ, it said he had $20 billion of customer funds in his personal bank accounts. And then they use that to go manipulate markets. And then we all end up with the same thing that we work to, curb, which is like, fractional reserve banking, aka Tether, which you see they print a bunch of Tether and then Bitcoin price goes up, right? So now they can print money to manipulate the markets. And then, all the exchanges keep their coins internally, and then the mining pools grow up, and then they control the consensus. And then the Bitcoin developers have their little company Blockstream, and then they can limit that and control the narratives. And then, yeah, I mean, I think if Satoshi were looking back at Bitcoin right now, I don't think he would be. I think he would be very proud of himself for starting such a thing, but seeing the way that it is now, I don't think he would be particularly happy, to see what everything has become, because he envisioned, the block size, being the way to scale Bitcoin, which I think was again flawed because he based it off of Moore's law, where the logic being that, okay, well, the blockchain grows linearly of the constant block size, but Moore's law grows exponentially. So therefore you should always have ample storage space to store the blockchain. And so, block sizes.
Is that why we have the halving?
Bigger. Well, the halving is the supply interval. So the halving is just to create kind of a rudimentary radioactive decay. It's exponential decay. E to the negative KT is what they use. And that has a half-life, if you remember that. And so this is just like mimicking a half-life. And that's why he did a halving every 4 years, because he wanted it to, I guess, exponentially decay. And so the reward halving is a slightly different mechanism. I'm talking about just the block size, which is how many transactions can fit right now. It's 1 megabyte. And so, if you have 1 megabyte every 10 minutes, but then Moore's law is increasing exponentially, which I think it's what the number of transistors doubles every 2 years or something like that. But now we're seeing the thinning out of that. And Moore's law is actually showing to be more logarithmic than exponential, right? Where it increased really quickly and it kept with that pace for a while, but now it's leveling off, or it might be more like a sigmoid curve, which is kind of like an S curve. So it looks like it's going exponential, but as you get to the top, it tapers. And that's kind of what's happening. If you notice, if you CPUs, they're not getting much faster than 4 gigahertz, because you have saturation of the actual quartz crystal that's holding your clock speed. And at a certain, speed, the piezoelectric effect becomes kind of unstable. And so we're kind of reaching that. So now they're just adding more cores. But then as transistors get smaller, you have all these unknown effects, such as like quantum tunneling, where electrons just disappear and teleport to the other side of a barrier. And that could ultimately result in zeros becoming 1 and causing, actual hardware faults, and it's destroying hardware, right? So, he was right and he was wrong. I mean, as far as how it is now, 1 megabyte block size, it's ridiculously small. It's $100 a transaction, and you can buy a terabyte hard drive for like 30, $40 now. It's just absolutely ridiculous to say that decreasing the block size and having it small is going to help decentralization, because really very few people even run Bitcoin nodes anymore. It's just the main wallet providers. And then, there's just a lot of issues, and I don't know, the philosophies and ethos have been lost, and it's been kind of unfortunate. I don't know if you feel the same, Nathan, just to watch this libertarian cypherpunk dream, emerging. I mean, I got into Bitcoin in like 2013. I mean, back then I didn't know if it was going to be made illegal. I mean, I was plotting I was like, okay, if they make it illegal here, I'm gonna go here. It was pretty anarchist and pretty libertarian. It was cool, and the people that were pushing Bitcoin and exchanging it and using it to buy stuff were people that believed in that vision of Bitcoin. Hey, we want to use this cryptocurrency because this is the cypherpunk dream. Now it's very seldom used. Merchant transactions have gone down significantly. People are hoarding it, which isn't really good for an economic system. It's just become more of a speculative asset than a currency, right? And especially in the technology and how it's able to manage I guess load has decreased chain usage, which ultimately is removing it from that purpose of being like an actual digital cash system that we can use on a global level, and just making it a digital asset. And now there's ETFs and BlackRock and all of these big hedge funds moving in. I mean, it was really unfortunate in 2020. You remember that, Nathan, with the S&P 500 correlating 100% with Bitcoin. That was kind of eerie, because Bitcoin was always supposed to be the safe haven asset. Okay, well, if the stock market crashes, Bitcoin will go up. And that's at least what we always had anticipated, but it correlated 1-to-1 during 2020, and it was pretty rough. And it was also, debasing that idea that it is going to be this safe haven asset. So I'd say like Bitcoin has hit some of the fundamentals of that vision, but it wasn't finished. It's still a beta. People don't realize why it starts with a 0. 0 means it's beta. It was never actually released as a 1.0. Satoshi released it as 0.1.0, and it's still, I think it's like 0.28 now or whatever, but it's still considered a beta as far as its versioning. And that's kind of how I see it too. It's a proof of concept. It shows us what we can do, but I don't believe it, philosophically, ethically, and architecturally has met those marks. And a lot of it's the cultural issues in crypto. Other ones is, lack of know-how and development. And I think there's just not been that fresh creativity that Satoshi has brought to Bitcoin that he brought in the original. It's just people kind of adding their own little things, but it kind of just got heavier and heavier and, more and more mucky. And so we've kind of taken it in a totally different direction. Like I said, with Nexus, it's just been looking at it and saying, okay, what did Bitcoin do? What does it do well? What does it not do well? Where are the flaws? What do we do to fix them? And so that's pretty much where I started. And like I said, it started with timekeeping protocols, and then supply protocol issues, like with the Bitcoin supply, for instance. Right now we're running into a crux, and this has been a theory that I've had that could potentially happen. It could not, but a type of deflationary collapse scenario where, right now it might happen, it might not this year. I was predicting 2028, but this last halving, you're already seeing it on crypto Twitter, people are complaining that Bitcoin didn't double. And so when you have this reward halving every 4 years, it creates this massive shock in the mining market. because now you're mining at a loss. Most of these miners are at very thin margins versus their electricity costs and their hardware costs, and how much Bitcoin they're actually able to produce. But let's say the price never gets up to 100,000. I think the reserves of Bitcoin for miners is the lowest it's ever been right now. I just saw some statistics on that, which means that all these miners are eating up all their Bitcoin to pay the power costs because they're mining at a loss right now, anticipating Bitcoin to get to that $100,000 mark or wherever it is where it's doubled the value from the halving. And if that doesn't happen and they run out of Bitcoin reserves, they're going to have to move their hash power somewhere else, Bitcoin Cash or Bitcoin SV or any other, SHA-256 ASIC, mineable chain. And then what's going to happen is Bitcoin reward the difficulty targeting happens every 2016 blocks. So if you lose a chunk of those miners, then the block time slows down, the emission slows down, everybody's profits go down even more, because if your chain is half the speed now you've got doubly half of your profits. Now you're a quarter of your profits because the block time's 20 minutes instead of 10. And then more transactions build up in the memory pool. It can't process all of them. More miners start jumping off. And at 2016 blocks, then instead of being 2 weeks, could be 1 month, and then it could become 2 months. And I mean, there is a potential for the chain kind of stalling. You're getting really slow, and I'm actually having to unstick it with a hard fork. That could happen. Or you could have economic issues with this anticipation that every time the reward halves, it doubles in value, which is completely ridiculous if you understand economics, because the Bitcoins already exist. There's like 19 million Bitcoins. It's not like the supply of Bitcoin cuts in half. It's that the emission cuts in half, but it's such a small, minuscule amount compared to how many Bitcoins are already mined. Is all a psychological game that people just expect and anticipate. And when that breaks down, we could have a lot of problems. And I think the supply halving is a big architectural issue in Bitcoin. I mean, it does what it's meant to do as far as limiting the supply and making it push more and more, to needing fees to drive it. But I think it's going to have a lot more problems as we're seeing now. And, people are already complaining. They bought a bunch of Bitcoin hoping that it was going to double because it historically does. But every time we double, it takes exponentially more resources to double it again, right? And so at this point, if there's not enough institutional investors pushing money in, it's not going to go. I think when the last time it was at 70,000, I think the views were at like 2 or 3 million, and now they're at like 400,000 for like certain YouTube influencers. Like the amount of people interested in Bitcoin right now is not the same as it was the last time we went to 70,000. So if there's not a big push up, it's gonna hurt the mining industry at some point, which is ultimately gonna hurt everybody else that's using Bitcoin. Fees are already going up to 100. I mean, if the chain slows down by half because miners have to jump off because they're running out of all their Bitcoin reserves to pay their power fees because they've been mining at a loss, then fees could go to 200 or 300, right? And that could help in maintaining the mining support, right? Because the transaction fees driving in do help support miners, but that's not a guarantee.
No, it's not a guarantee. Follow-up question: how does Nexus approach resolving a lot of these issues that we're talking about here?
Well, supply emission is independent of block time. So there's radioactive decay equations, e to the negative kt. Negative k is just like a decimal value you choose to set your half-life, essentially, and t is your time measure. So every minute there's a certain amount of Nexus that is released into these variables called reserves, which are not actual mint yet, but they're potential mint, and everybody keeps that same record. They all have the same exact reserve value. And then the reward for that block is dependent on how much is in that reserve. So that means if somebody comes on with a lot of mining power and pops off a lot of blocks quickly, they deplete the reserve, and then the rewards actually become fractional of that 1 minute span, so that there's no way you can actually increase the supply of Nexus by increasing the block time. That was a big problem back in the early days with multi-pools mining, where you basically have a pool that just switches their hash rate to the most profitable coin. Usually it's a coin that's in between difficulty readjustments. The price is high enough that they can pop off 2 or 3 times the amount of coins that should exist in that time frame before the difficulty adjusts. So that's one thing. Another thing is I've developed new difficulty adjustment algorithms that retarget on a per block basis so that it can respond very quickly to changes in hash rate, so that if a large miner jumps off, then you only really have 1 block interval that's a little bit slower, which could be 1 or 2 minutes off. And what's cool about it though is that reserve then adds back up, and then usually if the chain's slowed down, then you're going to get larger rewards for that until the reserve depletes again. So the supply always stays on track. It never has a halving. It's just always decreasing every minute, as, like I said, a radioactive decay equation. So there's a half-life of it, but not an actual halving that, causes major stresses on the market. And then we also have like multiple mining channels. So there's, 2 mining channels. One's prime, one's FPGA/ASICs at this point. And I anticipated that because you're not going to really get rid of ASICs, but there is a big backlash when GPUs get kicked off by ASICs, then that creates some centralization around just the ASIC ownership. GPUs are a little bit more decentralized as far as like people's availability to access them. So right now the prime channel is mined by GPUs, and then the hash channel is mined by ASICs and FPGAs. And then there's a proof of stake channel as well. And so all 3 of these channels check and balance each other. So in order to attack and say 51% attack Nexus, you would actually have to try to take over 2 of these channels, which creates a larger distribution of resources required to do such a thing. And so, it helps kind of maintain the security of the mining industry a little bit more decentralized.
Greatly
and a lot
increases
more
the cost
secure.
of attack.
Yes, significantly. And we haven't seen any 51% attacks, even with like lower hash rate. There was one along like 2018 somebody managed to pull one off, and that was a security flaw that I had in the proof of stake that I've since fixed. And that's kind of to get to my sentiment earlier. One of the reasons I respect the you don't know what you don't know in the security of blockchain is because I have direct experience with that. And you code something and you think there's going to be this, but you don't always know how somebody's going to think to exploit it, especially when you're the creator. Like Nathan has always said that the developers shouldn't be doing their own security analysis because they should be focusing on development. That's true to a degree, I believe, but also the other side of it is that, if you're just the developer, you're in your own thoughts about it, and you sometimes get in your own thought loop and you don't see things from another angle, and that could cause, higher levels of security issues. But I've seen a lot of things happen, and I've actually been really fortunate to have a lot of people attack Nexus over the years, and that's part of what's developed a lot of my security protocols and understanding, what could go wrong in blockchains and how those different protocols could be exploited.
Yeah. I mean, I imagine you're even more resilient as a result of those attacks. Because
Absolutely.
You learned, yeah.
And we have knowledge that no one else really does in regards to that because of all the ways that we've seen people be able to try to exploit it. And we've developed the protocol around a lot of those mindsets and seeing that where, you can't say that some of the other chains, like let's say Bitcoin clone or whatever, would know because they're just kind of copying and pasting. And it's a big problem in crypto is everybody just copies and pastes. Right now, everybody's copying the Ethereum virtual machine, which I think is probably, it's a terrible design. Like, I'm such a critic of it. I mean, everything is stored in 256 bits. So they touted it as this amazing masterpiece of 256-bit computing, but it's not. It's every computation is still done on the processor in 64 bits. It's just now you have to do that 4 times in order to do just one, addition operation. So like, for instance, if you want to add 1 + 1 = 2, in the virtual machine of Ethereum, it's actually having to store 3 32-byte integers that have to be computed in that way. And so you have this ridiculous amount of space that's required for each contract and each, integer, even though in Solidity they give you different integer types, an 8 or a 16 or whatever, they're all stored as 256 bits in the virtual machine. And I think that's one of their big flaws where they're going to really have a difficult time really scaling the Ethereum virtual machine and covering up a lot of the issues that they've encountered.
Viz, I'm going to hop in real quick. You had mentioned a few things earlier, and I want to talk a little bit about where we were and where we are with no speculation on the future because I'm not that smart.
Yeah.
In the beginning, if you remember a lot of the early projects, the Bitcoin space was extraordinarily charitable. The people that were building in the space were all trying to better the world, and it was those libertarian anarchic ideals that were there. I ran the crypto shit show and I changed the name to the Integrity Show because I had to change the name. And the reason behind the name change was that the code made humans act with integrity. It's an attribute that we grant ourselves in the most arrogant of arrogant fashions. And here we have a piece of code that's teaching us to behave better. And I think that's, something very interesting to ponder and think about. that's where we were. The incentives were such, and Bitcoin was successful enough that the money go up, guys. They won. We in the beginning we all thought that people were going to look at Bitcoin and go, what is it about this? Where does its value come from? What special attributes does it have to make number go up? And they would learn about peer-to-peer and decentralization and all the things that gave it its value. Well, that just wasn't the case, and that's kind of disheartening. Now, about where we are now. There was a Nobel laureate named Friedrich Hayek, right, in economics, German fella. And he talked about development of language, development of law, and development of money. And he said that there was hardly any notable development of monies since they went into the hands of government about the time that there was coinage, that there was virtually little development since coinage. Satoshi broke that. He broke that by distributing mining across so many different jurisdictions that, it was unenforceable. He made all the right moves to make sure it would get past its fledgling stage. And that was a pretty miraculous thing that happened there. Now, I don't believe that the BRICS currency would be on the table right now, if not for the success of Bitcoin. What we're seeing is thousands of years of pent-up frustration of wanting to develop on money, but couldn't because Bitcoin didn't break that, fuck you, I'm going to do it. You can look at the Liberty Dollar and Bernard von Nothaus, who tried to create, a precious metal-backed currency. Well, the federal government took care of him, didn't they? Right? So alternative currencies were always allowed to exist in very, very tight little districts, and usually during times of economic strife or war, right? But for anything to independently compete outside of gold and precious metals was a no-no up until Bitcoin. So that's kind of where it was. It's kind of where it is now. It's got everybody developing like crazy. It's just, thousands of years of pent-up frustration coming out in experimentation. A lot of it bad experimentation. And I guess kind of talking about tokenomics and talking a little bit about history and everything like that, I kind of wanted those to be my parting words, just those thoughts. And then I guess you guys can carry on. Thanks for joining us tonight, Viz. Thanks to Nate, who was on earlier. Frank, you knocked it out of the park. And look forward to be back with you guys next week.
Thanks, Nathan. I do have a few more questions for you, Viz, if you want to stay on just a little longer.
Yeah. Ask away, man.
Sweet. So you mentioned the Ethereum virtual machine being a bad idea to replicate and clone due to its inherent issues. You guys do have the Nexus virtual machine. How does that differ, and how does it fix the issues?
It's a register-based virtual machine. So, typically Ethereum is a stack machine, is what it's called. So you manage everything on a stack. You're pushing and popping from the stack. So you have, 5 or 10 operations. Do one operation on the virtual machine and you get amortized in that sense too. For anybody that doesn't know what amortized means, it means that your software is out of sync with the hardware. So, for instance, if you have a 64-bit, processor and you're running, 76-bit, numbers, you're going to be amortized because you're only going to be using, one small part of the next 64-bit register. So what I did is I built it as a 64-bit virtual machine because I started really thinking and just being like, okay, well, why have 256 bits? Okay, well, you might need to do computation, on smaller numbers, but 256 bits, if you break that into the total number of actual combinations, it's more than the number of atoms in the universe, right? So I couldn't see there being any need to have computation on that high of a number. Now, as far as storing and retrieving hashes, absolutely. So, we do support 250 up to 1024-bit data types in our virtual machine, but that's done just by concatenating a bunch of 64-bit registers. But all the computation on our virtual machine is done through 64 bits. So I built an actual memory management system that is a low-level register-based virtual machine that then essentially it gets compiled and optimized by the compiler into the registers, your L1 or L2 cache in your processor, so that when you're doing computation in our virtual machine, it's very, very, very fast. Like I think doing, multiplication, addition, subtraction, I was running like 30, 40 million operations per second, which is like an average of like 33 nanoseconds per instruction, where Ethereum ends up being about 1.7 million nanoseconds per instruction. So that was one thing that I felt was really important, because I looked at the size of a 64-bit integer, and it's just larger than any quantity of anything that you would ever have on Earth. And when you're talking about computing, you're talking about managing certain levels of inventory, or managing certain numbers, or the maximum amount theoretically in a currency, or all of those supplies, and you just don't need more than 64 bits. So that's one of the things that we've done. But we've also developed it too with kind of like a double accounting model, so that you get this really cool call and response, which opens up a lot of possibilities for, having, I guess, some sort of functional programming where one can call another and then it responds back with changing the state. So like you have like a conditional virtual machine and the Nexus virtual machine, and then you have like main registers, and the register is basically just a data packet that can store a certain amount of data, and then that data can be manipulated through those different operators, and it can be transferred and it can be claimed. But then you have conditional operations between, I want to transfer this to you, but I want to have a condition that you give me this much money in response, for instance, and then that executes. So it ends up being extremely fast. I mean, I was just doing a test net load like a few months ago, and I mean, we peaked at 3,000 transactions per second, just nothing. I've tested it up to 10,000, but really, you don't really run into computational bottlenecks as much as you run into bandwidth bottlenecks at this point. So it's pretty much gotten it efficient enough where your computer is not really having to work very hard to process it. But the downloading of that volume, like for instance, at 10,000 contracts per second, I was seeing about 5 megabytes per second of data that was running in and out. I did this on a local test so that I didn't have to have bandwidth being that limitation. But I mean, that was generating all the transactions on the same computer that I was processing all the transactions onto a local node, and it saturated, computationally at about 10,000 to 12,000 contracts per second. But if you had it over a local network with no bandwidth, and you had separate computers that are producing the transactions versus one processing it, you'd see much higher throughputs. So, my I guess idea with Nexus as it stands right now is to perfect the single dimensional blockchain route to understand all of the security. And then I'm deploying out a sharding architecture as well, that I call kind of a multi-dimensional chaining structure.
Three-dimensional blockchain, right?
Yeah, so three-dimensional blocks that link together as a chain of events. But this three-dimensional chain kind of increases the security of the system and also increases the capacity of the system. A lot of the sharding people, I think, have missed the point of using multi-layers of chaining and sharding rather than just a single layer. Like I think Ethereum tried to have their master chain and then there's sub-layers, but then they have issues with like, okay, well, what if I need to call a contract in another shard? Then you have to wait on that other shard to deliver me that data, and then by the time I'm waiting for that data, now it becomes sequential instead of parallel, right? Or procedural. So there's all these issues with the sharding that I haven't seen very many people focusing on. Ours, it kind of has 3 layers on it, and then it also kind of creates a decentralized mining pool protocol as well, so that you won't necessarily ever have mining pools once that's fully completed, and it allows it to kind of expand and contract with the capacity it needs, but forming it into this 3-dimensional structure. You can kind of see like a Rubik's Cube, and each layer of that is processing different parts of the state. And so then, you also, instead of chaining forward, between, blocks that are sequentially, one after the other, you're also at certain intervals chaining across. So what ends up happening is then you start creating a rigid 2-dimensional grid or a 2-dimensional structure that then cryptographically is locked together, so that if you change any part of any one of those pieces of structure, now you have to have all the other shards agree that you want to change that specific state once it's been cross-linked, and then basically rebuild an entirely new 2-dimensional shape, which just exponentially increases the resources to attack it. So, it's not known exactly, because it's not been deployed yet, obviously, if that 3-dimensional chaining structure is going to succumb to the same 51% attack surface. The way I at least have understood it, from my simulations and architectural designs, is that you'll have to get agreement of everybody. It won't just be able to be one miner that just submits a hash faster than everybody else. That's how a 51% attack works. In this sense, you need to get all of the miners to agree, because right now with Bitcoin, for instance, one hash rules all. So I mine a block. If that has a higher amount of proof of work, then another block that's competing, my block wins. And that's just it. And then that block determines the transaction history, period. So only one person can change, at least the history on that one block. Where with a 3-dimensional block, you don't have that luxury. You don't just get to make one hash and then you make a block. It takes a large collection of people to make the block. You have to have the L1 validators create the two-dimensional shape or the two-dimensional grid for the bottom, and then the L2 validators are going to be processing the contracts in their own sharded areas, and then the miners are going to be submitting shares based off of that root cube, is what it's called, and then those shares then aggregate into a Merkle tree that creates the final block hash. And then the collective work of all of the miners then is included in that block rather than one person's block, one person's proof of work. Because with Bitcoin, you could have millions of people mining, but only one hash is going to win. And so all of that other proof of work is thrown out. It's just, okay, you start mining a new block. All that electricity you expended does not actually give you some monetary value, where with a 3D block, it does. And so you'd have to have a massive coordinated cooperation of, 51% of the L1 validators, 51% of the L2 validators, and 51% of all the miners, which they all have to agree on that alternative transaction history in order for that to be woven together into a final block. So it makes it a lot more difficult. Even if you have 51% of the mining power of the network, you wouldn't actually be able to create your own three-dimensional block. You'd have to basically compete against all of the trust and the weight of all of the other levels. And so there's another mechanism too that's called trust that we built into it, where it simply is just, how consistently have you provided resources to the network? And that then is what's used to determine a part of the reliability of that node. And so if you get into conflicts, higher amounts of trust are able to, be considered to be a little bit more valid. And so that gives you the protections of new miners coming on just to execute an attack, or, people coming in to try to swarm. We also use the trust for the voting protocols because, DAOs, for instance, that rely entirely just on token supply are very easy to manipulate. I think a lot of people, at least with the old mindset of like, hey, we're building this to topple the banking systems and change the power structures of the world and build our own currencies. We neglect to realize that they have about $100 trillion in value all across the world in real estate, and they just have a ridiculous amount of money and a money printer. So we need to make the old money, invalid to the new time, if that makes sense. Where, old guard can't just go in and throw $1 billion at something and then, gain control of it. And that's kind of what they did with Bitcoin. They gained control of the markets, the miners, and the development by throwing a bunch of money at it. So the trust kind of helps combat that, where you don't just buy Nexus in order to get voting, or stake weight or anything like that. You actually have to build up trust. And then the higher your trust score, at least on the proof of stake, then the higher your rate of return. So you get from 0.5% to 3%, based on the amount of trust you have. So that creates incentive for you to be a consistent node validator. It solves the node incentive issues that Bitcoin has because it costs money to run a node, but you don't make any money from running a node. It curbs that. And also it adds an additional layer of security to a three-dimensional block when each one of these L1, L2, L3 validators have weight. Weight is basically your proof of work or your proof of stake, how many physical resources you've contributed to that block, and then trust. How long have you continually produced these physical resources for the chain? And then, think of the trust kind of as like a positive, and, the weight is kind of a negative. So the distance between those two would determine the validity of that block, or the total trust plus weight, essentially. And so then it becomes a lot more difficult. Now, in order to attack it, you'd have to have trust from years ago. So you'd have to long game it. You'd have to be, mining and building up your trust as much as you can, getting as many other people with as much trust, and then have all of that weight, which is computing power and stake and everything else, to then try to control it. And then you'd have to get coercion with all the other people as well that would be willing to, adhere to this alternative, reorganization per se, and, the L1 layer in order to change it. So it just makes it exponentially more difficult to break it, and it fixes a lot of those issues. And it also, I think, is going to be, the architecture that is the transistor that's going to allow everything to exist, because you only really need to keep 8 vertices of this root cube, and then all those 8 vertices are part of what are hashed together by the miners to create the block's hash. So everybody can only have these 8 hashes to represent one block instead of having to have the entire block. And then you have Merkle paths from each of these vertices to any part in that 3-dimensional block. And then you essentially can have this collectively created data structure that could end up being 100 gigabytes if it needed to be, but you'd only have to manage a small subset of it. But then you'd still be able to have the same security because you'd be able to verify any part of the transaction history into it. And then to get back to the register virtual machine, what's really cool about that is each register has a pre-state. And this is how I made it so you can reorg. I was talking about Ethereum doesn't reorg. It's not able to do a reorganization because you have to roll back the states. So let's say in the smart contract, it says I want to do, 5 squared. So you can do that, run 25 squared, and then your state's now 25 in this new block. But what if I want to revert that back? Then you're going to have to revert back that state tree, which means you're going to have to reverse that computation unless you have a state that recorded the prior value. With Nexus, I just went and I created this pre-state system. We have a pre-state and a post-state checksum, so you know the pre-state. And so if you roll back, you just roll back to the pre-state, so you don't actually have to reverse computation, because you could have something that's totally not even computation. You could be writing into a value, and if you don't know the previous value, you're not able to reverse on computation. So we fixed that because I think it's important for the chain to be able to, shift around based on, the highest weight, because you do want to have the highest weighted chain comparatively. But what's also cool about that is if I want, like in our light mode, for instance, we got a node running on a phone. And so with that, it only takes about 1 gigabyte of data. You download the chain, block headers, and then you download your sig chain. But if I want to get, like, let's say a register that you modified, Frank, from any part, I don't have to download. And let's say you have 1,000 transactions in your sig chain. I don't have to download those 1,000 transactions to know that state. I can just find the last transaction that modified that register state and download a Merkle transaction for that, take the Merkle proof into the block hash, and now I have that state of your register without having to know all your prior states. So that's something that comes in valuable with our cross-shard communication. If you have, a credit that you're debiting from, you just include the pre-state of the transaction of that prior one with a Merkle proof to a root cube, so that the validator basically gets 2 transactions if there's a dependent that's on another shard, so that it can process it in real time and maintain parallelization, and not need to know that that state is, all the previous states for that one transaction. You can just have that state built into it with the pre-state. And then other things to it, the reason it's called sig chains is because it's kind of like your own personal blockchain, and that's what we do with Nexus. We've created kind of a decentralized login system so that people don't have to manage their keys directly. You can still use complex keys for your passwords if you want, but it's a lot more familiar for people. I mean, we both know people use stupid passwords, but I think the probability of people using stupid passwords versus people losing their private keys, people lose their private keys, I think, a lot more than they can get hacked from just simple attacks, right? So we run it through dictionaries too, just to make sure that, people aren't using the wrong one as username, password, and PIN, and then use memory hard hashing algorithm called Argon to limit the computational bottleneck. And I calculate at least the complexity with an 8-character alphanumeric password. It would take about 5 million, 6 million years based on the computational requirements to try to break that sig chain. And so far they've been in the live for about 4 years now, almost 5, and haven't had any breaches of a sig chain specifically by somebody hacking a password. Which has been good. It seemed to have worked. But the really cool part about it is, since it's a chain of events, right, this solves a signature issue, because signatures are the heaviest part of a blockchain, right? Especially once you start getting in quantum resistance. For instance, Falcon, what we use, it's a quantum resistant signature scheme. It requires about 1/800 bytes for the public key, and I think about 1 kilobyte for the signature, somewhere around there. So it's about 1.5 to 2 kilobytes for the public key and the signature, which is the smallest quantum resistant signature scheme you can actually use. It's using NTRU lattices, which tend to be a little bit more compact. But we're going to need that. We're going to need quantum resistant encryption all the way. That's another flaw of Bitcoin. But to get to the signature aggregation, what's cool about it is all you need to do is you need to maintain the first signature and the last signature of the sig chain. So you can imagine, as you get to 1,000, 10,000, 100,000 transactions in your sig chain, now you've saved, 99,998 signatures, which, multiply that by 1 kilobyte or 2 kilobytes. You have a lot of data that you're saving. And this is a really cool feature with the signature chains, is because since you have a chain of events that go from your genesis transaction, your first one, to your last one, as long as you maintain the signature on your first and your last, you know that every single transaction between the two is fully, it has integrity of it, because it's all chained, right? And if any one of those transactions were changed, then it would be broken, right? So that's another cool thing that we've done for scaling and improving the signature issue. And we do use a type of segregated witness, not necessarily Bitcoins, but we do separate the public key and the signature from the actual hash of that transaction so that they can be pruned out. And that's one thing that I can say was a good idea. Not necessarily how they implemented segregated witness, but separating signatures from your transaction ID is really important, because you have transaction malleability attacks with, including the signature and TXID. for instance. I don't know if you're familiar with those, but
Dude,
you can just
you've gone so far over my head at this point. I gotta stop you because I'm lost, man. Like I appreciate you explaining it, but you've gone way above my skill level there. I'm
okay.
not like hardcore math guy, so when it comes to some of the things you're explaining,
Stop,
I'm
man.
just
Yeah.
a little lost. I do appreciate
Stop
you
me
taking
anytime,
the time
man.
to explain it. Yeah, man.
Yeah, and if you want me to
I wanted
explain in simpler terms, just let me know. I'm just giving you kind of an overview, I guess, of all the stuff.
yeah.
There's a lot there. So
You and I previously talked about how you're not a fan of monolithic kernels, and you were talking about
yes.
how, one of the ways to solve that was the redevelopment of the operating system kind of from the ground up. And some of the
Hmm.
stuff you've talked about there, I was wondering how you would deal with like IPC messages getting leaked, and that being like something that somebody can intercept if you're not using a monolithic kernel.
Yeah, I mean, you can still do that on a monolithic kernel if you know how to read the memory and what's happening on function calls and variables you can pass through. IPC, you just have to have some realm of encryption between each of these servers. But what's cool about microkernels is that you have different programs that communicate between one another. So I'm using the L4 microkernel architecture. So, I mean, to prevent eavesdropping, you simply just have, the proper encryption, and you have to have those keys stored in the proper places in the microkernel. But like a specific microkernel, a good microkernel doesn't have any policy on anything. It really just manages your thread. So every other aspect of the operating system is managed through independent computer programs. So this particular microkernel that I'm working off of, SEL4, also provides memory protection where you actually aren't able to access the memory of another running process just because of the way it has policies and these certain objects and data structures. And they've actually used SEL4 to prevent buffer overflow exploits on military drones. It's actually being used for developing military hardware because it's such a robust microkernel. And they actually have provided proofs, which I think is the only kernel that's ever had that, where you can run these proofs to verify that every aspect of the microkernel is functioning as it should. And these Python proofs, you should check it out, SEL4. So you do have the potential of IPC, if somebody's able to penetrate that deeply, but generally the computer, each program is going to be in its own sandbox on top of that, especially through the data objects. And then if you really want to be paranoid, you add encryption, which that's what I'm building essentially into it. Monolithic kernels, though, have a lot more issues than I think they solve at this point, just because they're just one massive computer program. So, a flaw in any part of that could compromise the entire kernel, right?
Yeah.
And we're just kind of at the point now where I think like Windows is just doomed for, always eternally having security flaws. And I think OS X is kind of in the same boat. It's a little bit better because it was based off of what FreeBSD was it? It was BSD, I think. But anyway, the fundamental software, if you remember, like, okay, I saw this video the other day, like somebody opened up PowerPoint on Windows 95, right? Instant. Now try to open it on Windows 10. It's going to take a minute, right? But our processors are so much faster. I mean, that was a 300 megahertz processor, like a Pentium 3, instant, right? Now it takes all this time because software has become so bloated. And I think operating systems are, probably one of the worst culprits.
Yeah. Have you seen the stuff they're trying to put in Windows 11?
And
If you got
more code doesn't mean better. And
oh, sorry, there's a little delay there.
what's
I
that?
was asking, have you seen some of the stuff they're trying to put in the Windows 11 with the AI stuff where you need an NPU and a Copilot plus PC? Really kind of like scary. What
Yeah.
level of access they're going to have to everything you're doing with screenshots every 5 seconds with recall and all that data that's flowing through. I mean, your average person doesn't want all that crap. They just want to like be able to edit their documents and do what they need to do and do their work. And then you're adding all this stuff on to the operating system that is really not that well tested. And
Yes.
I'm really fearful of what's going to come as a result of that in the terms of the exploit space and people running NPUs on their computers now. It's like I've heard a lot of horror stories about the TPU itself being a main issue, like security concerns around that and if it's backdoored or not and all that kind of stuff. But like now we're adding a whole nother coprocessor on to handle specific specific types of mathematical operations that are unique to AI, not just matrix multiplication stuff anymore. And it's like that's terrifying threat surface right there.
Yeah, and I mean, when you're a privacy advocate, you got to look all the way down to the operating system to understand the fundamental issue, right? Which I think is just the architecture of it. I mean, you're familiar with your InfoSec work that, once you penetrate through the very, very thin layer of armor, you've got access to the entire kernel in the PowerShell, and you own the computer. Once you bypass UAC, inject into Explorer.exe, or there's very simple bypasses that I consider all the security that they've added on to Windows is just like this very, very thin armor that, like, once you penetrate it, you have access to everything. Instead, what I'm seeing is that we need to lock everything down. We need to have every aspect of the software know itself, right? Like, a virus can hide on your file system because your file system doesn't know what each file should be. It's not keeping checksums of that. So if you have, files, blocks of the files assembled into Merkle proofs, then you're going to know at any point if a virus injects itself into the file, right? Because you see that the hashes break and the hashes, don't match. And so I see that this, especially in the internet too. I mean, network stuff. I mean, ARP messages are not authenticated. I mean, you can do any. I mean, even what BGP, Border Gate Protocol, is not authenticated. Did you see the MyEther wallet hack?
BGP is a disaster waiting to happen.
Oh
I
my
mean,
God. Oh yeah, I mean, it
Mudge
does.
testified in front of Congress about that, and I mean,
Yeah.
a lot of the issues are still there. It's not like they fixed
Oh
it.
yeah.
It's just,
No, they
and
just
we've
put
seen
band-aids on
BGP
it.
hijacks from countries where they literally are routing
Yeah.
entire traffic from another country through them, just
Uh-huh.
to be able to sniff it. It's crazy. And like,
Exactly. And
you get Cisco trying to build something better with like EIGRP, and it's still got issues just like BGP had. It's just, different set of issues.
yeah. Yeah, I learned a lot of that from Dino because Dino, one of my mentors, he was the first fellow at Cisco. We worked on ARPANET and MILNET. And so I got a really good insight into, like, your network engineer. Like, this guy pretty much built Cisco. He was the first fellow. I mean, he was the head honcho for a long time. He helped it grow, built a lot of the routers, operating system, all that stuff. And just the mindset of the early internet guys was just, hey, we're making an open system. They're idealist, everybody's trusted on the network, so it works. But as soon as it's gotten out into the wild, all these other problems have arisen where they're just, oh wait, well, we need to do SART now. We need to actually authenticate that. Oh, we need to authenticate, border gate protocol messages. Cause, like, I mean, my Ether wallet, they got BGP hijacked, and I think $100 million was stolen from it because they just found somebody, they rerouted their IP address and took control of it, and then didn't even have to reroute the DNS and just moved it to their server, cloned it, put a backdoor in it, and then got a security certificate, and boom, nobody knew the difference. And that's one thing that's really kind of scary on the internet is it works now, but you have no idea what's going on. You have no idea how much, if your traffic's being filtered out by BGP hijacking, or like if your website's going to be taken down just simply by something like that, which is really quite trivial to pull off. You just announce on BGP that you own a block of IP addresses, and it says, okay, cool, and then starts routing for you. Like, it doesn't have any, sense of ownership. And it's really kind of funny. Operating systems and the internet are really similar in that way, where, I mean, such a simple flaw.
It was built without the trust in mind. It was like a very different time, and they necessarily foresee all these issues coming down the line. So
exactly. And that's the thing that I see about blockchain is kind of like the internet. It was built with this ideology that, is intended to change things, where, the internet, they want it to be a free and open system. That's coming from the horse's mouth with Dino. But, as time has gone on, the attack surface has started to become a lot more understood, but nobody's reacted to that yet. Nobody's built a new operating system. We got Linux, but Linux was built, in the early times, and it's, monolithic. It's decent, but it's kind of like the other chains like Cardano. People aren't making viruses for Linux or trying to penetrate the security of Linux or assessing the attack surface as Linux because it's just not used as much, right? You can still get a virus for it, but it's kind of like how Apple was. Remember when Apple didn't get viruses? People used to always
Linux. There's a lot of viruses for Linux. It's just a lot of the people who are writing them. They're not writing them for end users. They're writing them to backdoor server architecture. They want to have a persistent hold on like something that's serving up something important to them. And there's a lot of ways to backdoor Linux. Like, you look at the Linux privilege escalation scripts alone, it checks all these different places where you could essentially hide something. Just like in Windows, if you get a really good place where you can put something, like, not too many people are using like Win persistence, or there's different ways that you can backdoor something that people don't see, that are far outside of like just backdooring a service or putting something in the startup entries. You start getting into these, and like Linux is just like that. I'm sure there's a larger percentage of Linux systems that are compromised and still serving up the content they're designed to do that are just not known. Like we saw that with the SSH backdoor that was really in the lib LCMA. You know, if that's another one only got caught because of an autist from Microsoft who noticed a half-second delay, and like we see. I'm sure there's more like that. You know, it's not like that's not a one-off. There's one they caught. So, you know, if something's used often enough, there's going to be people who are building shit to hide in it.
Yeah, exactly. And that's, I mean, you remember 10 years ago, everybody always, touted Macs as being, no viruses for Macs. And now they're all over Macs now, and they're on iPhones and they're on Androids because it's, just a matter of time. And I think a lot of that is just kind of this open architecture underneath the hood. The kernel only knows what it knows. And, when something can bypass that, then it's just going to continue operating. And it's kind of like a GUI, gumball, you just inject whatever in and it spits it whatever out. And so they put this hardened shell around it to be like, okay, well, but it's still inside. It's just going to spit whatever out. So, if we're reimagining architectures of operating systems, we can take all of this cybersecurity knowledge we have now and we can put it into an operating system that is privacy focused and that knows itself and that is hardened on every level of that microkernel's development, hardened with best practices and foresight of all these different exploits, so that something simple like a buffer overflow in one program can't compromise the system, or you can't have privilege escalation, or anything else like that. It will know if anything's been injected. It'll know its memory. It'll know its file system. And it'll use, Nexus and blockchain in order to authenticate that. And I think that's been one missing piece to be able to do that is you can build all of these structures internally to the computer where it can know itself. But if it's something that's locally on that hardware, then that's something that can be corrupted or manipulated or changed. And then it wouldn't ever know that it was changed, right? But if you have it based around, files have a hash of the Merkle proof in, a file system register that's housed on Nexus, then you'll know that that file is exactly what it should. When you open the file, you check your hashes, you make sure it's good. Anytime anything's executed from that file, you check your hashes. Then nothing can hide anywhere on the computer, and you harden it from a lot of those possibilities. And ideally, be able to curb things like, a vulnerability in SSH that it would be able to catch, right? And anticipate these things, because the developers make mistakes. And so the operating system should buffer those possible mistakes rather than, succumb to them. And that's kind of how it is now. The operating systems are really just Windows, Linux, and OS X, right? And that's it. And it makes sense why there's not other ones, because they've got the market share and people don't want to move to different operating systems because they like using their apps. And Windows did a very good job at siloing everybody under their operating system in that way. But I just don't think we're going to see all these security flaws go away until we have a totally new architecture that we build from the ground up, anticipating all of them.
You've talked about what you're building a bit with Nexus and the operating system. How far away year-wise do you think it would be before there'd actually be a usable operating system I could install on some hardware that would do what you're talking about?
It's hard to say. I'd say at least a few years. Right now I'm working on building the LXOS microkernel underneath Graphene. So anybody use Graphene OS for Android? They are basically running. Yeah, they're running a Linux kernel, and this is the thing. How do you get adoption, right? Because I could build it, but if you can't run your apps on it or whatever, people aren't going to use it. So I'm building the LXOS with the Linux compatibility layer, and I'm going to deploy it underneath Graphene to initially release it so that I don't have to build all the GUI and all that other stuff that can give you additional security, because that is something that the Graphene guys have on their roadmap kind of long term. They want to move to a microkernel. So that's how I'm starting it, at least right now, to get adoption. So it's going to start with mobile phones and all of that. But right now it's just me coding it. So if anybody else wants to help, it'll get done faster. But
if I had the skill to do kernel level programming, I would certainly help. But I am
it's really not that complicated, man. It's just like
I'll tell you what, stuff, you teach me what I got to learn, and I'll help you all you can. Man, I don't know that shit.
Just do it.
So
yeah, and what's cool about it is that Nexus kind of is doing a lot of it, right? Like there's a file system I'm building on Nexus to make a distributed file system with the file system registers and all that. So ideally, we'd only need to have a few servers and Nexus running, which the Nexus would be providing a lot of those operating system functionalities, because I want it to be distributed too, right? Where you can pay Nexus into the file system and you can make sure that You know, let's say your phone goes down and you lose it in a lake. You don't have to back up your files. It's automatically backed up on this distributed file system network. And then, you know, desktops eventually can host files for each other and create local little, you know, whether it's you and your buddies that just keep, you know, 10 computers on and, you know, store files for each other, or, you know, you pay to the public for people to do it too. So that's ideally like, as the more I finish Nexus, then the faster LXOS gets done, if that makes sense, because a lot of the heavy lifting for LXOS is going to be done by Nexus. It's just the microkernel and everything's going to be kind of sitting below Nexus. So it's just, you know, getting Nexus, I guess, less and less reliant on any externals. Like right now, it's totally free of any external library. It's set for OpenSSL. And I'm almost done getting rid of that, which is good because OpenSSL is a huge library, and you remember Heartbleed.
You know better than to roll your own crypto, though, I hope, right?
Oh, I'm not rolling my own crypto, bro. No.
Okay, good.
No, but I'm
Every time I
creating
hear
a
somebody
collective-
talking about doing that, I start to like have flashbacks.
No.
It's like,
Frank, I say the same shit to people. Like, trust me, I know. Like, the #1 rule of cryptography: don't roll your own crypto. No, but I am taking best standards. So, like Kyber, for instance, is a post-quantum standard, and I did create a post-quantum SSL, which uses the crypto object register in Nexus. So basically, it acts as a security certificate management service without needing a certificate authority. So you get the same effect essentially by saying, okay, I want to connect to this username. I'm going to download their crypto object register, and I'm going to check the public key that they're sending me in the key exchange mechanism, which is using Kyber in this particular context. And I'm going to hash that and then check that hash in their crypto object register and say, okay, this is the public key that they have, you know, generated deterministically from their SigChain credentials. Now I'm going to check an authentication. So now I want you to sign a message to me with your signed key, every one of them, you know, which has a timestamp and a nonce, everything, so you prevent replay attacks, to say, okay, I want you to verify that this is you sending this message by including a digital signature with a public key that hashes in your crypto package register. So you not only get certificate verification, but you get identity verification at the same time. So, I mean, that's about as far as I'd say. It's not rolling my own crypto, but I definitely utilize the cryptographic operations in unique ways such as that. But I don't actually create the fundamental cryptographic algorithms. Basically been building a post-quantum library. I've got embed TLS, if you're familiar with that, is for embedded TLS. I've included that in our LLC, which, you know, the LLC is the lower level cryptography, which is basically just a collection of a lot of really good cryptographic algorithms and standards, including RSA and ECDSA, and then post-quantum algorithms and stuff like that, that make it kind of portable and ready to have available to any developer. Is, I guess, partly a cryptographic library, but not anything that I myself would roll. The TLS has actually been the hardest part of getting rid of OpenSSL. If you look at Bitcoin, they got rid of OpenSSL as well when they had the DER encoding issues. But they actually just totally removed TLS on the RPC server, which I thought was highly irresponsible. I mean, your remote procedural call server, yeah, they say, oh, assuming it's only used locally, so just never open it up to any remote connections, and like just totally non-SSL. So I mean, that's something for anybody, you know, like every RPC server running Bitcoin Core is totally plain text. It's totally unencrypted because they just dropped TLS. Which I understand why. It's been a pain in the ass, but you know, yeah, I'm almost there. There's just a couple things, and then like format tests with the primality was a bit of a pain in the butt. But we even went down to software virtualized floating points. So when our virtual machine's completely done right now, I've been rolling it out in stages, and this is part of my practices. I don't just add too much complexity too fast. You want to add a little bit of complexity and then see how it is received and see how people try to manipulate it. So I mean, I literally stare at logs a lot of the day, just going, watching nodes, watching miners, watching people, watching what they're doing. Like, there's people double spending or trying to, you know, like sending, you know, credits already claimed and all sorts of stuff. But it shows me just kind of a natural rhythm of the network and seeing what people try to do to manipulate it. And then I add, you know, a little bit more complexity and a little bit more. And I think that's just, at least, you know, my perspective obviously is a little biased, but I think that's the only way to really do this responsibly. You can't deploy too much complexity because you have no idea what's going to be going wrong. Kind of like, you know, a scientific experiment. You change one variable at a time. You add little bits by little bits so that you can know what broke where, if there is that, and that you don't introduce these massive security flaws before it's fully understood how that last feature is going to be affected, in at least the security world. But So the reason I went on that tangent is software virtualized floating points. Right now, Ethereum doesn't support floating points, but this took me like a few months, man, to get it where you can actually emulate the Anticipate with the IEEE 754, I believe, standard for floating points with a 64-bit unsigned integer using all integer arithmetic. Because the reason you don't want to use floating points in consensus is because different processors have non-standard
round up
floating point
differently or
instructions,
some
so you
shit,
could get very
yeah.
slight deviations. Yeah, you get different
Yeah.
rounding characteristics. I've got fully software virtualized floating points,
That's pretty neat,
so we don't
man.
actually
It's,
touch double
and to have
anywhere
thought
in
of
the
that
code,
ahead
but
of
we have
time
our own
before you even ran into it,
64-bit
it's pretty
software
cool.
virtualized floating points. Yeah, man, thank you. That's something I really. So we're going to support fully, like, you know, if you want to have floating points in the virtual machine, we'll be able to, because we can safely do it with the software virtualization, and it's pretty quick too. It's just about as fast as the regular floating points, or plus or minus a bit, but yeah, it supports exponentiation, logarithms, and all the other stuff, power, fraction, basics. It's yeah. So that was another really fun part. Like, I've really focused on all of the little details, I guess, in the technical aspects of what makes a really solid blockchain, and what does it need, and why should we do it this way, and like how are we going to release these features, doing it slowly. So I'm very methodical with how I do it, and I think that's just how everybody should be doing it in crypto. We're trying to really keep the vision of Satoshi alive, I guess, and seeing the way the industry is now. I wouldn't say that it is, but we
It
need
doesn't seem that
more
way
people
some
seeing it
days,
that way.
for sure.
Yeah, I mean, I even saw this tweet of like, let me explain to you why nobody builds apps on blockchain. He's like, well, because it's too expensive, it costs too much to develop, and all these other things. Like, I mean, if you want to hire a Solidity developer, I think they're 170,000 a year at minimum, and then you got all the other idiosyncrasies with Ethereum and the issues. You don't even know if your contract failed until you've published it, and you don't know if you had enough fee, and if you didn't put enough fee in, like, I think the highest amount was like $5,000 that somebody paid to have their contract terminate and not even execute because they didn't put enough fee in. There's so many of those issues in Ethereum, and it's just it really is reminiscent of not having the forethought to develop something that would effectively provide for the world. And so even the dream of smart contracts has kind of been dying, and now it's just all okay. Well, what's your tokenomics now? What's your token? Like, I'm going to build a token, or I'm going to build a meme coin, which is essentially a token too. But nobody's actually building dApps because it's too expensive and clunky, and it doesn't really do what you need it to do. And so that whole promise has even been falling apart from Ethereum, which is another huge gap that I think too. Like, hey, well, I do like the concept of code is law. Like, how do we develop new legal systems and court systems and all this stuff, and really fundamentally reimagine how the world could be? And I think people that are thinking about that are becoming less and less, because there's just so much stupid money to be made from doing nothing and following the trends of the times, and celebrities launching meme coins now, and then liquidity pools staking one coin for another coin for another coin, and then selling it back as Ethereum, and talking about the tokenomics loops, that's a big problem, right, with Ethereum. And just, I don't know, the decentralized finance stuff, to me, I'm a bit of a critic of it. I think a little bit too much of a hype, and I don't see it actually like doing what it could do for, like, revamping all these financial systems. And it's just, I'm making a token and I'm staking this token for another token, and then getting a loan based on this token, and then now I'm done, right? It's not doing anything meaningful. And I think that's what we really need to do to get the rest of the world involved on crypto. Even at this last, bull cycle, quote unquote, the number of views is like, I think 1/8 of what it was when it was really exploding in 2021. The views of, Bitcoin influencers is down significantly, which means that the public's interest in crypto is declining, not increasing. Institutional interest is increasing, but that's not going to get worldwide adoption. That's just going to create another speculative stock market. And that's kind of where it looks like it's going right now, which
Unfortunately,
in some senses
I'm not a fan of that being the case, though.
yeah, me
I think
neither.
it's very
But
much
that,
against what it was designed to be.
exactly. But that leaves a wide open market for us, right? Like, working on decentralized social media right now. I mean, there's people that build on Nexus with no code tools because it's all API driven, right? So it's really powerful in that way, because like now, like, you don't have to even be a coder to build a dApp on Nexus, right? It becomes really powerful, and it solves that issue, and peer-to-peer messenger, and then decentralized Uber app for transportation, and peer-to-peer markets and things like that. Those are useful, valuable things that will also be useful and valuable to people in a time of crisis. Let's say COVID happens again, or supply chain issues, or they kill too many chickens and now people can't get eggs, or they can't get food or whatever. Like, what are they going to do? We need to have alternative infrastructure, not just for the principle of it, but I mean, the society that we're seeing right now it's been falling apart, and it took me like, I think like 6 months to get a harp in 2022 actually, because they couldn't get the parts for it. There was just massive supply chain issues, and I think that was just the beginning, right? So I mean, even thinking ahead a little bit more, okay, like the promise and principles of crypto, yes, that's great, but will we really need it in the future? The dollar collapses, or banks go insolvent, or stock market collapses. Like, let's say we have another Great Depression. How can we build technology that will help us support at least, a semblance of the quality of life that we have now? And I think that's something that I think a lot of people are overlooking, is that the
Right.
world is not getting more stable right now. We need new tools that are going to help us provide at least some stability for our children or our friends or our family. And ultimately, we all have what each other needs. I mean, 200 people is all you need to have fully self-sufficient community. It's Tristan da Cunha actually is this little remote island. It's over by St. Helena, right? They're grouped into Ascension Island, Tristan da Cunha, and St. Helena. It's 200 people. 200 people live on one of the most remote islands in the world. They get like, I think a ship visits them like once every month or two, and they're totally self-sufficient. They grow their own food. They have their own, sheep, and make their own, alcohol and whatever else. People, do their weaving. They make their clothes and from the wool. They get totally self-sufficient. And it's just all these middlemen are in the way of us, providing for each other. I mean, even when you're buying a product, right, on Etsy or Amazon, it's somebody else that thought that product and manufactured it, and then somebody else that manufactured it, and then someone else that bought it, right? It's all ultimately people. So if you can remove all of that and take the people out of the way of, like, capturing the fees, like, Uber, like, hey, I'm driving here to drive you there. I'm already here, so I'll pick you up, no problem. But they take 20% of it. I think we need to really get away from that, where everything can be directly peer-to-peer. And I think we could have really functional systems in that sense. Different people have different talents that produce different values, different people, and getting those big middlemen out of the middle of it, I think will make everybody a lot more prosperous, and also give us more assurance that that grid can't fail, right? I mean, producing a power, sharing the power, producing the food, and different products that we can trade with each other in geospatial markets over longer distances, and then having transportation based off of different people's locations and needs. Hey, I'm in North Vegas with you, Frank, and then we're going down to the funeral, and oh, hey, there's a guy over on this side that needed this delivered. I'm going to just pick up this package on the way, and I'm going to earn $10. Hey, that covers my gas money. People naturally are already doing what each other needs. We just don't know who is doing what. So if you had a system that could show you that, like, I don't know what that future would entirely look like. I can only speculate. But, I would guess that it would be a lot better than what we have now, because right now it's just,
Absolutely.
hey, I go here and that's that, but wow, I mean, I could be providing something for somebody as a byproduct of what I'm already doing. One man's trash is another man's treasure, and that happens everywhere. It's really cool how life works, that it is a thing. And so, if you can capture that essence in kind of local economic systems and trades, and, tie that in with the cryptocurrency, and then all the other additional infrastructure that's possible, it becomes really powerful.
Absolutely. I wanted to just pivot before we kind of wrap up. We've been at it like 2.5 hours. And one other question. In my industry specifically, there seem to be a lot of assholes who get in positions of power, who abuse their authority, treat people badly. How do you think that kind of thing could be tackled, where if we are going to build a better system, that the people who get put in positions where they're making decisions for others are not freaking jerks?
I'm glad you asked, man. That's another big issue with society, right? And it's funny you asked, because I've been actually thinking about this particular problem for about 6 or 7 years, and studying corruption to back it up too. I'm like, okay, I've had a lot of really great test subjects, like corruption, facing it, like politics, all that stuff. And I think, let's just kind of start with like one of the premises of blockchain. They're like, okay, peer to peer, it's a flat system, right? It's supposed to be flat. A lot of, anarchists and libertarians believe somewhat in that, but that I think is a logical fallacy. It's an issue because you can't have a flat system because not everybody's got the same level of capability, right? Some people are more capable in other fields than others. Some people just want to be told what to do and go home and, make love to their wife and have a beer and go to bed, right? They don't want to think about all these different things. And then other people really are very capable leaders. So how do you filter the two apart from one another in a way that when somebody gets to become, quote unquote, a leader, they're not going to abuse that, exactly like you just said. And the way I believe is that it needs to be a bottom up social system, not a top down social system. So right now, the way typical corporations work, you have the board of directors. The board of directors hires the CEO hires the rest of the C-suite. Each of the C-suite then gets appointed a certain number of departments or department heads. They appoint them, and then the department heads then appoint managers, and then managers then hire people, and so on and so forth, and it goes down the chain. So therefore, every person, their power is focused upward, right? The manager has to keep the department head happy, and the department head has to keep whoever the C-suite is managing their department happy, and then they have to keep the CEO happy, and the CEO has to keep the board happy. And if any of those things fall out of sync, then somebody's getting fired in that chain of command, right? That's a top-down system. But if it's a bottom-up social system, imagine if you had an organization, let's say just a small one, 40 people, and these 40 people are your typical work people, right? They're performing, whatever task. Now, if you split that into 5 groups of 8, the reason these numbers are chosen is 8 statistically has been studied to be the most effective number of people as far as for creative pursuits, and 5 has been the most effective number for making decisions. So if you have these 5 groups of 8, each one of these groups of 8 then has a different function for the company, and then they elect somebody from their group of 8 to represent their group on the layer above as far as like making decisions, but they're ultimately accountable to the base layer. And so if they're not accurately representing, they're being dicks to their 8 people that they're supposed to be representing, then they just get voted out and somebody else replaces them, where the power then is derived from the base of the system rather than the top of the system. And that naturally, just the game theory will unravel a lot of that dickhead behavior, because they're mean to the people below, probably because somebody above them is mean to them, or they're frustrated in their life, and there's no accountability to it because they're only accountable to their manager, their higher up, rather than to the people that they represent and that are actually executing the task. So if you flip it that way, then you're going to create a meritocratic system where people from the bottom are going to ascend higher up this stack, which could be many more layers, 5, 8, 13, 21, so forth, to keep increasing in size. And I mean, the capacity of this can grow exponentially. I mean, you can get 10,920 people. I think 5 groups of 8 is 40. And then with the added layer of 13 is 520. And then to 21, then it becomes 10,960, I believe. Which is very, very large organization. You'll need a few layers, but another cool part about it is it checks and balances power. So let's say we have 5 groups of 8, and then each one of these groups of 8 is also a representative of a group of 13. So that's going to be 520 people. So now the base group of 13 is going to be the worker bee group. They're the task executors, and then they elect someone to represent them. That forms a group of 8, and then that group of 8 then collects between one another and votes and decides on the strategies for the tasks. And then the group of 5 that forms from those group of 8 then forms kind of like the higher level decision strategy group. So now if one person has gotten up to the top group of 5, then they've had to gone through 2 levels of elections. They had to be elected by the group of 13 and elected by the group of 8. That's more eyes seeing them and their behavior, and that's also more direct accountability, because I can ascend from the group of 13, right? Let's say I'm trying to manipulate and take power, control, maybe I can trick that group of 13, but the group of 8, they can see and they can report, and then they can vote you out and push you back down to the group of 13, forcing the group to have to elect someone else. So you have this, direct accountability on every layer. And as you add a layer to increase the capacity, you increase the total number of steps that you have to do to get to a certain point where you're always accountable to that base layer. And so you create, we call it a starfish. So I've been designing this new social system. I'm describing some aspects of it, which started testing it in 2021, actually. And it was really fascinating to see how it worked. I mean, we had 2 moles on our team that were just trying to sabotage things from inside the team, like totally identified and booted out in like less than a week. It's crazy how like these, the collective awareness of people. It's like this experiment they did with this jar of jelly beans. I think I've told you this before, Frank, Or if you take, you know, a jar of jelly beans and you have 100 people guess how many jelly beans are in the jar and then average out all their guesses, it ends up being within a few percent accuracy. Like it's 97, 98, 99% the correct answer. So when you pass an idea or a perception or anything through enough eyes, all of their collective guesses as they become averaged together create pretty close to the correct answer. So, you know, in the sense of identifying corruption, you know, like what's been happening to your friend, if this manager was accountable to your friend and his group of what they worked, he would act totally different. But he's acting like a fool because he has no accountability to it. He has no accountability to the people that he's representing. And so he mistreats them. So when you flip that, where the people at the top now, they are directly accountable to the people at the bottom, I think that's a more holistic social system that also takes into account like meritocracy. Some people are more or less capable than others. And those more capable people need to be making the more capable decisions. Right, you don't want to have somebody that, you know, is cognitively disabled to be in charge of nuclear codes, for instance, because they could make a bad decision that it affects the lives of millions or billions of people. But you also don't want to have a raging megalomaniac in charge of the nuclear codes as well, you know. And with the current U.S. system, it's just like 0 or 1. It's one hash rules all. Like with Bitcoin, you know, you get elected as the president, you're president for 4 years, you can do whatever the hell you want. Or, you know, you get appointed as the manager, you know, from the board head. Like you can treat your employees as bad as you want, just as long as they have a reasonable enough performance to keep your higher ups happy with your work. So that's another thing that I think is really important on in decentralization, right? The people are the biggest security flaw, right? You know, so this social system really helps to combat that and also scale people socially, right? Because social scaling is a big problem, especially in democratic systems. And also, you know, giving everybody, I guess, a place where they can excel and become, you know, the fullest that they want to be, or whatever level of the organization. Now, this system is called the starfishes, and you know, 5 arms of each starfish. It also like has other interesting protocols where like if an arm gets totally corrupted, it can be cut off, right? Just like think of it like an infection. Corruption is like an infection. It can infect a limb, and if it doesn't get fought off, it's going to infect everything else unless you detach it. And that's one thing I really noticed with corruption by studying it. The number one common denominator between all of it is it wants to spread. It always wants to spread itself. Bad ideas want to spread themselves. You know, corrupt ideas want to spread themselves. Liberty loves company, you know. So containing that and isolating that's really important as well. But this system that I've been describing, I think could be used eventually like to run countries or states all the way up to creating, you know, international starfishes where you have just layers and layers and layers. It's kind of like a fractal that grows up. But I think it would create a lot more security in social systems and prevent, you know, issues from happening. Like, you know, you've suggested about, you know, people, you know, being dicks and really causing harm on others, not having any direct accountability to it just because of the hierarchical system. And most blockchains have CEOs now, right? You always have the CEO and the CTO and the C-suite and whatever. And I thought that was just heavily ironic because you got these decentralized protocols on software anyway, but then you have a CEO of a blockchain. I thought it was supposed to be a decentralized economy. And then, you know, the narrative started shifting away from decentralized economies to companies. And then when you don't have a company, people are like, but what are you then if you're not a company? You know, it's a decentralized economy, guys, you know? So yeah, I think that's one of the biggest flaws in actually blockchain in the industry is that we're using these old hierarchical social systems on this new paradigm, and it's just always gonna eventually become centralized. Centralization is kind of like entropy in the system, right? Unless there's a constant flow of energy into the system to maintain that decentralization, it's just people are going to centralize things. And the social system, I think, is actually almost one of the most important aspects of it because that determines the results of everything else.
Well said. Last question before I kind of get going here is how do you feel about dev worship in the crypto community? I hear a lot of people talk about that being an issue. I haven't really observed it too much myself, but is that an issue?
Absolutely. I've struggled with that a lot, like just kind of hiding from people, and people just do tend to like see devs as gods in some way, which I think is a big problem because ultimately for a decentralized system to function, everybody's got to kind of find their own merit within it. And the dev worship also leads to one person having too much power, like Vitalik. everybody worships in. And a lot of it too is like these people want it, right? And they find, oh, I can be this, crypto god. I want everybody to worship me and look at me and yay. But I think also as a part of the problem, it can be a part of the solution too, right? I've had to kind of come into that later in my years of it because I've always fought it and just like, guys, like just stop looking to me for all the answers. Like, let's get involved, let's do stuff, like. But another side of it too is I think there is a need for some sort of symbolic representation of the philosophies, just like Satoshi, right? Like that represents the principles of something without being somebody that's going to utilize that for power. So I think it's not ideal, but I don't think there's any way to get around it at this current juncture until more people start to realize that like they can learn these things too. And people I think tend to idolize things that they feel are more than them. But I don't think anybody's ever tried to be more than what they are. And so as more people are able to see that and be like, oh, wait, I can do this and this, ideally it could change. But, another bigger problem than just dev worship I noticed too is the master slave relationship. Okay. So, the original premise of, creating economic prosperity for ourselves is that, hey, now I'm free from the bondage of slavery through economic slavery. But what I noticed happen, which has been quite unfortunate and difficult to navigate, is that when somebody fully like realize, hey, I'm free now, like I have money to buy, whatever I needed, and I'm not a debt slave anymore, and now I can take care of my family and whatever else, they tend to then think themselves as the master. They don't have any in between this master slave. They just are like, okay, well, I'm going to be a slave and stay a slave and worship the dev, right? Or I can be the master of the dev, and that happens. And there's really no in between. They think like, okay, well, either worship the dev or I'm going to control the dev. And that's happened. I mean, people buy a bunch of coins and then use that to push their weight around. So I'm going to dump everything unless you do exactly what I want. That happens a lot to the devs, So it's the dev worship kind of mixes into that same problem where it's like, okay, the dev's the master and, I'm the slave, or, I have freed myself and now I'm no longer a master or no longer a slave. So that means I must be the master. And they just can't think of like, oh, hey, this can be a collective effort where we can all work towards a common goal and everybody has their part in it. There doesn't need to be like one that's more important than the other. Everything just is, what it needs, kind of like cells in a body, red blood cells, white blood cells, dendritic cells, T cells, everything. They all have their own specific function. You wouldn't say that one is more or less important than the other because when, one aspect of that body subsystem fails, usually the body fails, right? So yeah, that's the biggest problem I've seen, like kind of in context with the dev worship and everything too. It's just the master slave relationship. People aren't able to break out of that psychological vacuum. They can only see the pendulum other way. Like I'm either the master or I'm the
Everybody seems to
slave.
think they're broken and need help getting fixed, and I don't understand it because most people are just fine. It's just weird.
Yeah, but then when they perceive themselves to be fixed, then they think that everyone else is broken and that they're the new master. Like it goes
really weird.
Both ends of the spectrum. Yeah, and it's just kind of the difficulty, and like I don't think going to be something that's going to change overnight. I mean, it's embedded deeply in the human psychology all across the world. I mean, everybody's been enslaved for a very long time. And so it's just going to take generations of eroding away at that mindset before it's able to change bit by bit. And that's kind of, like I said, the dilemma with like the dev worship or not, or whatever, the master slave stuff is like, I fought it for a long time, and it doesn't change. People they're going to idolize you, or they're going to hate you, or they're going to try to take you over. That's just kind of how it has worked. And until more people are able to stand up and be like, oh, okay, like I'm part of a larger thing instead of I am the entire thing or I'm below the entire thing. Like being a part of that.
Don't you know who I am?
Yeah, exactly. Don't you know who I am? I'm the creator of Ethereum and blah, 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 and blah, blah, blah. You're talking about Charles Hoskinson, right? Don't you know who I am? You asked me to check the support email. Remember that? It's just like that, and that happens like with the dev worship. Then they get this God complex, and then that makes them less effective too, because they think they're more capable than they really are, because they've got inflated egos, and then they make mistakes, and then you end up with Cardano.
Ooh, good one. Oh man. All right. So I think that's a good stopping point here. Nearly 3 hours into the cast, man. Thank you so much for your time today, Colin. And it's always great shooting the shit with you. Let's catch up again soon.
Yeah, likewise, man.
definitely talk offline. All right.
Yeah, but
Excellent.
catch you later, man. Thank you.
Thank you. All right, everybody. That's it for this cast. 2 hours, 43 minutes, and 39 seconds in. Thank you all for watching. Greatly appreciate your time and your attention. I'm going to try to do my little outro thing here, and hopefully it will work.
To the sound waves, secrets of the dark maze, dark codes in the nighttime, information, no lines. We're free in the spotlight, chatting through the late night. Smart contracts are lying, auditing, they're defying. CounterSurveil in my ear, security we engineer. Learn the truth, don't disappear. CounterSurveil, we're right here. Crypto dreams and data streams. Listen close, it's closer than it seems. Fix the flaws, see through the smog. CounterSurveil, join the blog. Information overflow. What we reap is what we sow. In this world of endless glow, facts we need to truly know. Hackers in the digits crawl. Watch your back, they'll break your wall. CounterSurveil standing tall. Together we decode it all. CounterSurveil in my ear, security we engineer. Learn the truth, don't disappear. CounterSurveil, we're right here. CounterSurveil in my ear, security we engineer. Learn the truth, don't disappear. CounterSurveil, we're right here. Crypto dreams and data streams. Listen close, it's closer than it seems. Fix the flaws, see through the smog. CounterSurveil, join the blog. Information overflow. What we reap is what we sow. In this world of endless glow, facts we need to truly know. Information overflow. What we reap is what we sow. In this world of endless glow, facts we need to truly know. Hackers in the ditches crawl. Watch your back, they'll break your wall. CounterSurveil standing tall. Together we decode it all. Crypto dreams and data streams. Listen close, it's closer than it seems. Face the flaws, see through the smog. CounterSurveil, join the blog. Hackers in the ditches crawl. Watch your back, they'll break your wall. CounterSurveil standing tall. Together we decode it all. Hackers in the digits crawl. Watch your back, they'll break your wall. CounterSurveil standing tall. Together we decode it all. CounterSurveil in my ear. Watch your back, they'll break your wall. CounterSurveil standing tall. Together we decode it